Over time. I'm your host, Chris Vecchio in New York, Ilya Spivaks in San Francisco, and Dylan Radigans in Milan. To take you through the next hour as we wrap up this trading day, futures market closes at 5 Eastern, 4 Central. If you're on the website, you're on the platform, come over to YouTube. Tell us what you're trading today, what you think of this action. A late day sell-off with volatility spiking a full point and stocks losing all those hard-earned gains after the German election results came out yesterday. Gold does push up to a new all-time high. Crude oil remains tethered right around $70 a barrel. Dollar looks like it's still potentially rolling over, although that late-day move in stocks sends the dollar back to its session highs. Overall, it's a full trading week here. We don't have any holidays, so that's the good news. It's a quiet macro week. That's the bad news. In between, we'll have Nvidia earnings on Wednesday. So there's a lot to chew on here. Gentlemen, Friday's sell-off was pretty nasty. Ilya, growth concerns are in play. The PMI release that comes out on Friday morning shows that the economy could be teetering towards recession. Prices are up, growth momentum is down, and stocks, they just don't like it. Ilya, is this a new paradigm moving forward?
New in the sense that it's coming to fruition, familiar to those of us that have been talking about it for the year and a half, basically saying that the world economy is operating on one leg of its three-leg stool. Europe hasn't grown in a year and a half, despite vigorous attempts. China has stalled since reopening from COVID. The U.S. economy, meanwhile, has powered ahead, and the reason it's powered ahead has been the buoyancy in the service sector because manufacturing has basically stalled. Obviously, during the pandemic itself, it was manufacturing that was shining. Most demand went to goods. People were stuck at home. They didn't go out and consume services nearly as much. They just bought stuff and shipped it to their house. Since we've had a rebalancing towards services where goods has been anemic and all this quote unquote revenge spending has gone to services, and that's been overwhelmingly the source of growth. What we find in these PMI numbers are that the service sector has issued its first contraction in February in 25 months. What we also find is that this is not a one-off, it's the second consecutive month of unexpected weakness in the service sector and therefore in the overall U.S. economy, weakest economic expansion overall in 17 months. That's despite manufacturing improving a bit. When we start to read the details, they get scarier. The confidence indicators about forward-looking expectations, sharply lower. New orders, sharply lower. And the anecdotal questioning of the people in the survey saying all of this is about uncertainty related to federal government policy. Moreover, the uptick in the manufacturing side is being attributed to the front running of tariffs. In other words, a temporary thing. So we have here the makeup of a situation where Europe is not any better off, China is not any better off, the U.S. was the last of the three major global engines to power us forward, and without the service sector, that engine is stopped. So we are in a situation where you could paper over all kinds of stressors as long as there was growth. You could look the other way on tariffs as long as they were more noise than action. You could look the other way on geopolitics. You could look the other way on looming refinancing risk of cheap COVID money. All of those things were digestible as long as there was growth, because that means you could have money tomorrow if you lost money today. Well, that's going away apparently. So if we continue to see more of this, it's liquidation and risk aversion that's on the menu. And of course, that means stocks are expensive, bonds are cheap, so on and so forth.
Dylan, in that PMI report that was released Friday, they made this note that Ilya was alluding to, quote, companies report widespread concerns about the impact of federal government policies ranging from spending cuts to tariffs and geopolitical developments. At what point does the market and does the economy stop thinking that it's bread and circus and theater and it becomes something legitimate that goes into spending plans? Are we at that inflection point yet?
I don't think we are. I think that the desire to believe, it's sort of like a religion at this point. Like it's going to take a lot. And I mean, Ilya, obviously, there's plenty of reasons why Ilya, and not just Ilya, others who are reading these tea leaves can be absolutely correct and ultimately, benefit from being correct. But I think also, again, it to me, it feels like it's going to take a lot more than a PMI number. What's it going to take? It's going to take some bad, scary jobs number.
Mm-hmm.
It's going to take that'll get everybody squirreled up. It's going to take like lowered guidance.
Yes.
Like you're going to need get like FedEx being like or Norfolk.
Well, and Walmart kind of gave us that, right?
And so yeah, so that
we got a weak retail sales number. Then Walmart comes out and scares everybody with its guidance. Then you get the PMIs, and you go, okay, wait a second.
And then
these things are starting to make a line.
And lighter FedEx, if you start to see the sort of leading sectors of the economy worn down, or just do more of what Ilya's already describing, just more of it in more places, and you throw a jobs number in there. So I'd say you're good to go until the first Friday in March, and then if you get a wacky jobs number, but it's going to take a lot. Just because the desire to believe in the glory of the super glide, not to mention the Pavlovian training of a generation of investors and traders to buy dips.
Yeah, I mean, the first week of March is not to be underplayed here. First of all, March 4th is ostensibly when those tariffs on Mexico and Canada go into effect. And then I would imagine that Friday, the 7th, is when we get the next set of NFPs. That's next week.
Well, you say they're ostensibly going to go into effect next week. To quote the President of the United States directly, I look at some of these agreements and I say, who would ever sign a thing like this? The tariffs will go forward, yes. We'll make up a lot of territory. Our country will be liquid and rich again, end quote. Donald Trump is the person who signed those agreements.
Right.
When he tore up NAFTA and put the USMCA in place.
I mean, Donald Trump, nothing the man says is true. That's the general principle.
Which means these tariffs are probably not going into place next week, Dylan. If we're going
and also the tariffs that were supposed to go into effect on in the first days of February were going in with this level of conviction until less than 24 hours later. They weren't. They in fact went into effect. They just didn't hold for
which goes
more than 24 hours.
That the oil trade that in 2025, my most winning trading strategy was to sell oil on geopolitical
that's where we're going.
Rallies.
Yep.
Yeah.
And my 2025 thesis is to buy the dips on Trumpian terror.
The problem is what these PMIs implies. The tariffs don't have to happen for businesses to freak out about what to do 6 months and 9 months forward. I think that's
because no one
probably the scariest thing of all is that businesses go, listen, maybe they don't happen, but how are we supposed to plan?
Yeah. I just reoriented a small business that I'm operating out of Italy to focus almost all of the growth and sales strategy within Europe, just to avoid who needs the risk. I mean, and this is a flea on a dog's ass in the scope of the business world. But I'm, to the degree to which we're in a meeting with the board saying there's plenty of market in Europe, in the Middle East for our products. Why bother even building an infrastructure right now to deal with America when the whole thing can get blown up on a Tuesday morning with a tweet like a $28 million government grant for housing that one day it's here, next day it's gone. And I'm sure that and the bigger the business, the bigger the risk, the bigger the reason to be more cautious. It can't be good for business, basically, to have no policy clarity, particularly when it comes to imports.
Well, especially when the administration is at odds with itself. I mean, we're reading now that Secretary of State Marco Rubio is scrambling to issue waivers on the unraveling of USAID because all of a sudden it's like, wait, we do want to keep these ISIS prisoners in prison. We don't want them to come out and then come here and do something we don't want them to do. We do want to spend money on containing infectious diseases where they are in Africa because we don't want them to come here. And so there's all these waivers that now come out, but of course the funding is stuck. And The Economist reports extensively on this because the actual bank accounts associated with USAID have been scrubbed. So there's all these court injunctions and waivers, but then things get jammed up. So if you're a business owner and you look at this and you go, okay, well, maybe the tariffs come, they go, but the level of volatility here means that even if I get the last minute 11th hour reprieve, because the whole thing's set up in such a haphazard way, I may get jammed up anyway. So why am I even going to bother? Let me just back up here.
I find it interesting that the market is responding so forcefully intraday with volatility the way that it did, where we spike up at the start of the session, we then drop down lower. Ilya, we were near the lows when you and I were talking midday on Futures Power Hour, and that really was the turning point. And then we jump up from about 17.4 to where we are just north of, we're wrapped around 19 right now. And I suppose that's a different layer to this volatility. There were spikes last week where intraday would spike up and then it'd come back in and the market would rebound. Obviously, we're not seeing that type of action here. But Dylan, I can't help but wonder, right? I'm just, who's the guy that signed the agreement that Trump is bashing right now? According to the White House website, trumpwhitehouse.archives.gov, President Donald J. Trump's U.S.-Mexico-Canada agreement delivers a historic win. This is the most modern balance. This is not to say like Donald Trump's such an idiot. Why is he attacking his own trade agreement? No, this is like, where's he operating from? If the tariffs are still coming next week, that's probably a carrot, right? If we're going to try to disentangle Trump lingo, it's probably a carrot to get something sweeter or an indication that more progress is going to be made in some renegotiation with Mexico and Canada. I would posit then, longer term, if all this tariff saber rattling is ultimately a way for him to renegotiate the USMCA that he signed into law without having to
expire next year, by the way.
Right, that is the background here, right? He wants to extend it, but now after seeing it in action since his first term, he thinks that there need to be more provisions made to it. So instead of just simply looking to get it extended, we are effectively changing the scope of the USMCA now, lest Canada and Mexico lose that free trade agreement, which would hurt their economies more than ours. So, yeah, Dylan, there's a lot of overhang because of these comments about tariffs, but if trying to just think about this as objectively as possible, if these are stepping stones towards a rewritten trade deal, Trump isn't going to revisit that trade deal in the next year or two. This tariff thing then becomes a sort of Damocles to a non-issue altogether. So I think we're going to have to deal with this slinky action again, this zigzag, where we're going to get ginned up about this for a few days. Maybe we hear some comments midweek from Trudeau or from
I get it, but how do you? I think Ilya makes an essential point, which is let's assume 95% of the time nothing's going to happen, but there's always a chance something could happen, and whether it happens or not, the fact that the noise machine is at maximum volume is affecting business decisions who are trying to, and that it's like the fear of the thing creates the thing that we fear, even if the thing that you fear never actually happens, which maybe makes no sense, but I think you know exactly what I'm saying.
No, and the velocity of reversal is just so fast that even when something happens, like with USAID, where you go, wait, hold on, not that part, bring that back. It's not so clear cut. And even though that there's been a reversal on the decision, undoing the damage and uncorking whatever bottleneck you've created, it's not so straightforward. And it's not so quick as just changing your mind. So it seems like, reasonably, businesses are looking at this and going, this is just not the kind of environment where I'm going to say, you know what, there is a predictability of the rules of the road whereby I can say, on the strength of these assumptions, I am going to do this or that. You just can't assume. And so as a savvy business owner, you might be inclined to sit back and go, you know what, I have this capital, I'm not going to deploy it. I'm just going to sit on this and wait.
Or I'm going to deploy it into more stable environments that have more predictable policy.
Such as those things exist in an environment where the world's largest economy and its only real source of growth is also the instability.
For sure. Yeah, I mean, there's two different things, right? But anyway, go ahead, Chris. The point is that the stock market is obviously vulnerable, not just for all those reasons, but also because it's still at relatively high levels.
Yes.
Right, and it's not, we talk about firing and these job cuts continuing to rise from the federal government. Apollo Global Management sent out a note this weekend suggesting that with total employment in the U.S. at 160 million, with about 7 million people unemployed and 5 million people changing jobs every month, 300,000 federal jobs on their own lost is not significant. And, how many new jobless claims do we see every single week? About 200,000. So 300,000 jobs lost altogether over the course of a year. It can be absorbed by a strong labor market. However, studies show that for every federal employee, there are 2 contractors. As a result, if we're laying off 300,000 people, the total number of layoffs could ultimately be closer to 1 million. So lobbing off 1 million jobs, that's different, because if you think about an economy that needs to add about 115,000 every month for the next 12 months to keep the unemployment rate at its current level, you're talking about an economy that's going to add roughly like 1.3 million jobs over the course of a year. And so we're going to take 1 million jobs out of the equation. We're talking about 300,000 jobs added over the next 12 months, potentially. That's a very, very, very different type of economic outlook and change in aggregate demand for the economy. But I suppose, Dylan, you mentioned what's going on in Europe right now. I find your perspective on how you're looking to scale a business there locally really insightful. It almost somewhat mirrors what Friedrich Merz, the new German leader, who, assuming the coalition comes together, of the CDU-CSU, was alluding to yesterday, that Europe basically needs to become independent of the U.S. It needs to rapidly rearm itself. It needs to not be so reliant on the people across the pond.
No, it needs to be totally independent so that it can. Right now, Europe is just an appendage to whatever American policy wants and whatever the American economy does. And, this is a clear wake-up call for the collective Europe, which is not a small economy or a small group of people. If there was ever an incentive for the sort of petty differences of the French and the Germans and the Spanish and the British and the Austrians and the Italians to let it all go, throw up huge pile of money, build a huge pile of nuclear weapons, and deregulate and make a more robust market, it should be nothing more than the fact that the United States and Russia are now allies against Europe for the first time in 80 years.
Oh, yeah, we frequently talk about credit spreads widening out as a potential to risk in broader markets. We often look at the OFR, the Financial Stress Index, from the Office of Financial Research, which is still up and running. It is a government website. So that is something that could be removed or the database tinkered with, as we've seen with like the BLS. For people who look at stats, the BLS has gone offline. Census has gone offline at points. So I point to this here. We looked at this during the commercial real estate meltdown. I suppose if we want to talk about that on our chart, we need to go to all here to get really the full purview. We'll let that load quickly. We could see here, this is our commercial real estate bubble issue. Oh no, SVB's failing. Over the past year, the only thing that's come close to that kind of stretch was last August. Very clearly right now, according to this particular set of metrics based on credit, equity valuation, funding, safe assets, volatility, financial stress right now is not that significant.
Right.
Right. Why is the credit market not freaking out the way that equities have over the past 48 hours of trading?
Well, I think you have to look at the whole of what equities are showing you, and I think Dylan's point here is salient. What you're going to need to see a broader freak out is you're going to need to see this stuff start to come out in heavier duty data and become obvious and inescapable for a broader audience. I think what you're looking at here is us looking through some PMI data, some CPI data, which was also worrying, some ISM data that was also worrying, all of which started to tell you the service sector is wobbling in a way that it hasn't before, and this is the pillar of global growth, and there's an issue. But these are early indications, and we've not seen that show up. And when you look at the S&P, it's near the middle of its range from early December. NASDAQ, middle of its range from early December. It's down, but it's not collapsing. There isn't the kind of situation here where you would expect credit crisis-like dynamics where people would go, I am not parting with my cash for any reason, full stop, period. No, you can't get a loan. And then credit spreads would blow out. That's not what we're seeing yet. I think importantly, it was also not what we were seeing in the first half of 2008, which didn't prevent us from seeing what we then saw in the second half. So would you have been wise to wait to be a seller of risk into the second half of 08? Ultimately, no. It would have made sense, and it was much more opportune to be a seller earlier. So obviously, we don't have all of the confirmation, but needless to say, this is the essence of looking for attractive opportunities in markets. You're not looking for the markets to have recognized the issue that you're looking to trade. You're looking to anticipate it to some extent, with evidence, of course. And so when you look at this data and you see the market start to react, but maybe not go into full capitulation, credit squeeze, run for the hills mode, this is your cue to go, maybe I'll get a little bear curious in my exposure. And if everything really hits the fan, that's when I layer in.
Bear curious. I'll never admit to that. Right now it feels like this is a dead spot for stocks, Ilya, from like that long-term perspective. We keep going back and forth. If you're at the midpoint of a multi-month trading range, what do? You like shorting the range to the top? If you want to get long here, this isn't a great spot to get long here because you're kind of catching a falling knife. Tony talks about reading the tape. VIX going out the day near the late session highs, I think says a lot about the action right now. Heading into tomorrow, it's also kind of a typical Monday this year. Mondays and Fridays have produced annualized losses in excess of 35%. Tuesday, Wednesday, Thursdays have produced annualized gains in excess of 40%. Wednesday, I think right now has an annualized gain of 96%. So if you short Friday, Monday, if you're long Tuesday, Wednesday, Thursday, you have had a hell of a year right now. Maybe that continues tomorrow, guys. But as we look into tomorrow's markets, we see a pretty split board here of the ETFs that we track. There's 25, 11 are green, 14 are in the red. The worst performer, SMH. SMH is off by 2.63%. Not sure you guys caught the headline over the weekend, but apparently a TD Cowen analyst did a channel check on how Microsoft's data center applications and leases are going through, and they received word that Microsoft is going around canceling some of its data center contracts, which in context of what we heard last week from Satya Nadella on that podcast, all speaks to a potential overbuild for the arena.
Mm-hmm.
But later in the day, right, where do we, who do you trust is my point. I point that out because we get this, there's a letter that's sent out from Jefferies from their investor relations team that's basically like, look, let me just clip this and pull this into here. Okay. Like, Microsoft itself is strongly refuting any change to their data center strategy. Again, this is just like with Trump. We're hearing two different stories from two different sources about the same exact thing. It's kind of like the mineral rights deal. We get a mineral rights deal that's sent out by Axios today. Is it the real thing? Maybe not, because it seems very dramatically opposed to what we're hearing from Trump himself. The point I'm getting at, though, is oversupply, the overbuilding of railroads, Ilya, certainly seems to be something thematically bothering the markets here on this Monday. We see it Friday. We see it here Monday. How seriously should we take this concern as a potential prick to the bubble at a time when sentiment is clearly ebbing?
I think what you have to respect about the price action here is sort of the defense mechanism that the market would have against headlines like this has been clearly degraded. And so this is the time when the markets might start to get spooked about exactly this kind of stuff. You can shrug off all kinds of things. Again, as long as there's growth, as long as the economy is growing, then if you get shell-shocked, if you lose money, if you make a mistake today, as long as demand overall is there and things are expanding, then there is new money to make tomorrow. If the business cycle is turning inward on itself, or there is at least a credible concern that it is, as we've just discussed, all of a sudden you become much less sure that there is, in fact, new money to have, at least near term. And if that's the case, you're going to be a lot more circumspect about outlays today, because you can say, you know what? I don't want to lose this money. Because what if there's not money tomorrow? Because there's a recession coming, because demand is weakening, et cetera, et cetera, et cetera. So all of a sudden, headlines like this, that 6 months ago, 4 months ago, 2 months ago, might have been shrugged off to say, okay, this is like a one. Does this change the grand and powerful AI future? No. Okay, moving on. But if there's no growth to give you the confidence to say the great and powerful AI future is coming on the timescale you thought, if there is suddenly a question about future money, even in the near term, now you're not so ready to part with capital. Now you're going to care about stuff like this. And this is just one flavor. The market has had a very strong defense system against negative sentiment because growth was powering ahead and indeed accelerating. The end of last year was a period of explosive acceleration in growth. Well, now we're unraveling to the weakest levels in 2 years, as apparently that was some sort of a blow-off sentiment top. Maybe. Now you're going to be vulnerable to things like this. So it's not so much that the headline is very impactful by itself. It's that the market decided to care. That's the big deal.
It's fascinating because these companies, you think that the stock prices in SMH haven't gone anywhere, Dylan, over the past almost, we're 9 months now. We're talking about late May when we start trading into the 240s. And it's now late February and we're still in the 240s. So this is, a year basically now, getting close to it, that semiconductors have stalled out. They were the growth engine for the market in the first half of last year. So the fact that the NASDAQ has been able to push higher says a lot about the spreading of the breath. But one would think that the benefit of time would mean that, okay, well, if we trade sideways for a while, then these ridiculous PE ratios, they can come back in. We can put some, score on the board, right? We can put some crooked numbers up there, get the market confident that our valuations are worthwhile, and the earnings will speak for themselves. I would point out that SMH, we look at the historical trailing 12 months PE ratio, where we were last May, it was about 41.6. SMH's trailing 12-month PE ratio as of February 12th is 48.64. So the index hasn't gone anywhere for the past 9 months, and the PE ratios have not come back down. So where's the earnings? Where are the earnings? It's a problem right now for semiconductors, which a few days ago looked like, hey, maybe we're breaking out, but we get this Cohen report, the Microsoft report, we get the Satya Nadella podcast last week. SMH has been going through it. Of course, we have Nvidia earnings this week. Dylan, is this the Holy Grail? Is this what we're waiting for? Is this our savior? Jensen, is he coming to save us?
I mean, it would be amazing if he can do it again. I mean, I tend to think that, we said this going back as almost probably 2, 3, 4 quarters ago, that it's not that Nvidia has stopped performing, although maybe it's relatively more modest. I emphasize relatively, but it's more that Wall Street has gotten better at forecasting it, so that the gap between modeling and analyst projections and reality compressed, such that whatever they did, the earnings report itself was no longer the financial carnival that it once was. I would be shocked if Nvidia does anything that moves the stock in any meaningful way. So I don't think it's I think that, I guess, the most obvious risk is that Nvidia or Jensen specifically says something that is viewed to validate the amplified fears manifest by the so-called channel check at Microsoft. And it all speaks to a market that is anxious to hold on to its lofty valuations, but at the same time is increasingly, and I think understandably, skittish for all the reasons that Ilya's been laying out. So it's hard for me to see. I feel like Nvidia is either a non-event or a bad event. I mean, listen, it'd be entertaining I have no financial position with any of these things right now, but I would be charmed, I suppose, to see if Nvidia can blow it out and the stock can go up 15% on the day and all the things that it's capable of in the past. That would be a legendary event, but it seems to be the least likely. It's either going to be a non-event or it's going to be viewed as validation of some evidence of trouble in paradise.
Yeah, so one wonders what happens if the same thing happens here as did with the PMIs. So you get a strong manufacturing number, but S&P Global writes up this whole thing about, well, look, the survey suggests that the past 2 months, January and February, is front running of tariffs. This is temporary. And then Nvidia comes out and says, oh, we had these excellent results in the past quarter, but actually our forward guidance from here is much more reserved because tariff risk and supply chains and everything, we need to do our thing, and the cooling effect that has on demand, and blah, 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 blah. And so what you end up with is a kind of encouraging headline that then gives you forward guidance, much as you had with Walmart, that tells you it isn't the last quarter you need to be worried about. It's the next 3.
I think that it doesn't really matter what happens in the background here. Nvidia is sailing into very tough waters already. There is this discrepancy between how the market's treated companies that are performing well with their earnings and those that are not. And we've seen this quarter that the market has been rewarding those positive earnings releases less than they typically do. How do we define this? If we look at the 2 days before an earnings release and the 2 days after, right? companies that have beat their earnings estimates last quarter for Q4 2024, they've seen an average price increase of 0.5% in that window, 2 days before, 2 days after. But that's below the 5-year average of a 1% increase during that window. So gains are about half of what they usually are. And then again, we've seen that companies are losing ground. They've seen an average price decrease of about 1.8% in the 2 days before and the 2 days after. They're actually not being punished more than they usually are. That's less than the 5-year average of 2.3% during that same window, but it's lopsided still, right? Sure, the misses aren't hurting as much as they typically do, but the beats are definitely not being rewarded. And I think if we look at the compression on both ends right now, it speaks to a group of investors, not traders, but really the longer term folks who are very much in a holding period. They don't necessarily care what happened in the rearview mirror. What happened in 2024, that's not the fiscal and monetary policy that's going to be guiding us in the future. That's not the geopolitical relationships, the trade barriers that will be guiding us in the future, the earnings that we need to project and look towards. It's a completely different world. The world we just grew up in, with a stock market that was trudging to all-time highs seemingly every 4 or 5 days last year, that world is dead. This is a new one. And this new one, we're still trying to make, heads from tails. We don't know which way to go yet. So a 4-month trading range for ES and the NASDAQ continue. For Nvidia, it's near range lows, you might say, that we're holding up in the fourth quarter. But for a brief interlude here in late January, early February, we're back very much in a place where we were comfortable for the past several months. But a drop below 128, that could be problematic going into the second half of this week. Guys, you mentioned that this is a week where, Nvidia obviously matters a lot. Ilya, you know better than most. The macro data is fairly thin. The bond auction calendar is fairly thin. What's the most important thing that traders need to be watching for, either data-wise, based on the facts, or narrative-wise, based in the stories this week?
Well, it's because there's not a whole lot of macro data on the calendar until we get to Friday's PCE numbers. Now it becomes a question of synthesis. And this is where I think watching the price action is really key. Obviously, there's going to be a lot of speculation around the Nvidia earnings just because it's become a kind of macro release unto itself. And so you might expect that there's going to be some fuzziness in baseline measures of sentiment, like let's say the S&P 500 as a kind of overall risk appetite gauge. You're probably going to get some level of, let's say, absent follow through and lack of conviction, some hours, maybe a day before. So tomorrow might be kind of a waiting for things to happen. Wednesday might be sort of a slow day, just as we wait and people don't want to jump in front of the event risk. And then, of course, if we do, that becomes an indicator onto itself. If the market is willing to make, let's say, a big move tomorrow before the Nvidia earnings without wanting that conviction, that's going to tell you something. I think the most important thing you can do here is let the price action speak for itself, especially on risk reward grounds. Again, looking at the S&P here, we're at the bottom of the congestion range since we set that high before the DeepSeek gap. We haven't even overcome that high, never mind early December. So since the beginning of the year, we've carved out a kind of internal range, and we are at its bottom. It doesn't really make risk reward sense to be a seller here, nor does it make confirmation sense to be a buyer. The price action is going to decide here. This is not one of those weeks where you have a clear macro indicator to tell you something. That might actually be the more concerning thing. If Friday's PMI numbers were the last word on the macro environment, then today was a story about follow through on the price action following those numbers. And that tells you this is the default that the market is finding. That should be concerning.
Dylan, it's the second half of, well, not quite the second half of the week yet, but it's Tuesday tomorrow. And absent of all the data what's the most important thing that traders need to be watching for this coming week?
I mean, unfortunately, I mean, it's super predictable, but I think that it's obviously, you always have to be aware of the possibility that Trump's going to make good on one of his economic threats. I think that's why the PMI numbers are the ones that they are. And I think that I think that it's not rhetoric. It would be evidence of follow through on the rhetoric from Trump. I mean, it's sort of like now, because even Musk, right? Like that Musk email has got all that attention over the last few days, where if you don't respond to the email, you're fired and blah, blah, blah. But then all of a sudden Monday comes and they're like, oh, actually, you don't have to respond to the email and nobody's getting fired, which has sort of become the standard behavioral pattern and increasing expectation from the Trump administration, which that they say something, shocking and outrageous, and then there's no follow through. But because the president of the United States of America, or the first buddy of the president of the United States of America, apparently have an incredible amount of power, right? It's one thing if a crazy person on talk radio says, oh, we should do this, we'll take Canada, Gulf of America, whatever. But because the office of the presidency and the newly created office of the first buddy have so much apparent power, that the words continue to be the primary risk. But I think that the number one issue is evidence of follow through in any place, any location at any time.
Yeah, I'm now
it'd be like Israel or Iran actually going to war instead of just talking about it.
Right. Yeah, that's an apt comparison. Yeah, that is an apt comparison. We need to see some meat on the bone. I keep going back to Doge because I'm trying to figure out again, like, what levers are we pulling here? And maybe the Doge tracker on Polymarket's down, but it still only says $55 billion saved for taxpayers in waste and fraud. Dylan, I'm excited to see the lawsuits for the fraud, right? Fraud's illegal in this country. So if we're finding fraudulent payments that are being made with taxpayer money, then surely people are going to be arrested for all this fraud that they found. Otherwise, it just, to me, seems like money that's been allocated by Congress that people just don't like where it's going. Again, fine, just don't pass a new budget and don't allocate the money there. But $55 billion saved, if that's really the amount, is a drop in the bucket compared to a $4.5 trillion spending bill that looks like it's coming down the pipeline this week. I suppose that's something that we can watch moving forward. Changes in corporate tax rates. Will there be a change in the SALT cap? Will there be a change in child tax credit? What will happen to Medicaid, Medicare? I mean, all those things could very well be important, because you have to think that by the time a bill gets out to the public, given the thin majorities that Republicans have, 5 seats on a good day in the House, if everyone's present, that you can't lose that many votes. And so if it's going to pass the House, then it probably can pass the Senate. And if the House and Senate are pushing forward legislation, we've seen historically, even this year, Trump will speak up on it. And if the legislation is something that he's not going to sign, he'll try to kill it before he has to veto it, and can potentially get, overridden by the nullification process there. I think that's perhaps the most important thing to watch here. Obviously, the tariffs matter a lot, but is it this Calvin ball set of tariffs where we make up the reasons for why we're going to be implementing them so they fit the feeling of the moment? Can't ignore that. But I think in terms of the sector rotation here, which is something I tap on as my North Star from time to time, we just have to take an honest check here. We'll do our own channel check, gentlemen. And that channel's looking pretty ugly. XLY, consumer discretionary. Granted, big Tesla consideration here. Nonetheless, setting a new swing low here for the year, new closing low, and all of a sudden that uptrend that looks broken looks like it's expiring into a new series of lower highs and lower lows. We can go over to, say, the banks in either XLF or KRE. The big banks don't look terrible. The regional banks don't look that great and may soon be losing their uptrend from the midpoint of last year. Likewise, technology, tech, banks, retail, consumer discretionary. These are the things that are early cycle bull stuff. And what a change from where we were just barely a week ago when XLK was at all-time closing highs, and XRT hadn't broken down yet, and SMH hadn't broken down yet. But again, another uptrend that could be lost sometime soon. If we re-anchor this to the most recent swing low in February, we're not quite there yet. But if XLK is rolling over, if XLY, if KRE, if XRT are rolling over, and then if consumer staples continue to outperform everything else, hold on a second here. This has been ripping. That's the exact opposite end. XLP, XLV, and healthcare has been holding up despite all of the nonsense with UNH. Guys, this is a market that's actually beneath the surface in the last few days has decidedly been way more defensive than it had been just a week or two ago. And it's been a dramatic about face. It's not just like the growth names have backed off. It's that people have said, oh, sell growth, buy value, and also take some money out of the market. This is a change in behavior. We haven't seen this type of rotation, I'd say, perhaps going back to August. Ilya, am I misreading this and overreacting? Although you're a bear, so I feel like I'm just speaking your language now.
Well, it's really the timing here. Yes, we haven't seen this since August. What did we see in August?
Growth scare.
We saw a growth scare. What happened to Fed policy expectations going into August from about mid-April through to then? That same U.S. economic surprise index that we were talking about earlier today on Futures Power Hour that I like to dredge up every chance I can on macro money right after this show, by the way. Stay tuned. It told us that perceptions of U.S. economic vigor already started to deteriorate by mid-April going into May, and that August was really the place where they got to their peak concern. And what did the Fed do? By September, the Fed reacted. They were very dovish. It turned out the economy wasn't quite on as weak a footing, and things normalized. This setup here tells you that actually maybe the election got in the way, but that those concerns that were on display then, those same concerns are on display now, and the Fed's reaction function is to get dovish. So then the anticipation might then be we need more rate cuts into the outlook. Bonds are too cheap. Stocks are too expensive. And we don't have any time for the Fed to talk away any of these things until the FOMC in March, which is some time away yet. So this sort of lays a table here.
So let's say you were bear curious.
Yes.
Where would you begin?
You usually do that stuff in college, Dylan.
You'd begin with the bonds. You'd look at the yen. You'd look at selling the dollar. You'd look at buying all things against it, as a matter of fact, because you would expect that there would be a shift toward a more dovish setting for U.S. monetary policy. So you would expect lower yields. You would expect a weaker dollar. You would expect that something would see the yen outperform even other currencies against the dollar, because you would expect a degree of liquidation. You would expect weakness in crude oil. You would expect weakness in other proxies for growth like copper. You're starting to kind of see those things. Crude oil attempted to break its range. It didn't quite make it, but it seems to be attempting to form some kind of a breakdown. So is copper. So we're in a situation where you'd start to go, okay, what benefits from growth and what benefits from the Fed becoming more dovish? And you'd look at all those things. Stocks obviously are the obvious kind of short growth vehicle, but I don't think you have the confirmation here to do it. I think you had it last week when you were back near the December highs and the pot odds made sense. And so even though you didn't have confirmation, you had the trajectory trajectory and an attractive setup. You don't have that right now. I think if you take the range out on, let's say, ES or NQ, something more attractive presents itself. If you bounce, something more attractive presents itself. But I would not be laying on new risk in equities. I'm, of course, already short. I just rolled my short verticals on put verticals on the Qs, on SPY. I've been holding a put vertical on IWM, which is the Russell, for about 2 weeks now. That's working and still has a bunch of time on it. So I have that exposure.
You've killed the Russell the last 4 months, man. Like you got it from what, like 2,400 down to 22, and then back. Then you reshorted again near 23. It's been a good trade.
It's the one that's been thank you. It's the one that's been the most sensitive to growth concerns, and I think for me, looking at the macro rather than sort of riding the hopium, that's been the one that's worked better because, of course, the hopium is tough to fight. But Russell, because it's more sensitive to cyclical things, it's really shown much more response to the kind of things I look at.
Russell looks like it's in really ugly shape. That uptrend from the September, we can go to that 8-hour chart, right? You have the September and then the January swing lows here. And even on this intra 8-hour chart, we could see here, we rally up to that point. And then that swing low that we have at the start of February, it's our point of failure.
Yeah.
So the Russell looks like
nasty.
I had my best laid plans were to buy the, NASDAQ near 21,850 and the Russell near 2,200. And the action that we're seeing looks really ugly. There's no sign of a sustainable bounce. Volatility is not staying low when it comes in. Not loving it, but lower rates are good for gold.
Yeah.
2968.90 here. Gold did set a new all-time high. Dylan, this continues to move up. It looks like we are trying desperately to find a technical break up to $3,000 an ounce this week. I suppose that's something to look forward to. Oil, I put this on last night. I don't know. What time did I put this on last night? Say 10:26. I haven't been able to get filled in a crude position all day long. And I don't even think I want to anymore. I know this is going to get bumped off the board in a little bit, but the volatility disappeared. There's a vol spike overnight that I was looking to take advantage of. As we're tethered near 70, I couldn't do it. Dylan, what are we looking forward to in the world of geopolitics now with oil? Or is it nothing?
I mean, I the obvious thing here is a slowing global economy and additional headwinds due to American political noise, all of which would be oil negative. Not to mention, there's some version of diminished geopolitical conflict in the margins of the chaos, all of which speaks to neutral or lower oil. I mean, I can't see on the screen what the volatility is like. I was entertaining a put or a call spread, but I don't know if volatility is not that great. But something as out of the money calls if you had more volatility. But it's hard to see how there's an oil rally. That's the bottom line.
Mm-hmm. Yeah.
As we wind this up, I saw that Jamie Dimon today noted that the government is inefficient and Doge is doing work that needs to be done. And so I suppose to go out on a lighter note here, I really appreciate that Elon Musk is trying to make the government more like the private sector, where you have to send emails to your boss pointlessly, endlessly, and then those emails get aggregated into a line report for that person's manager to read, and then you'll have meetings about those emails that were sent out.
AI is going to read all the emails, bro. There's no more. What?
Can we also get the AI to write them, and then everybody's efficiency is improved?
Yes, there you go.
Right. So really, the solution is you create an AI agent, and you ask the AI agent, "What did you do for me this week?" And that writes your email for you. But it's really beautiful to see that we're streamlining the American government by adding all those layers of emails that were, if you're lucky, you can work on the weekend or at night when you're supposed to be with your family. So thank you for that. And with that, overtime is now out of time. Listen, this isn't a comedy show. I never said it was going to be funny. We'll be back tomorrow, same time, same place, Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Dylan Milan and Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Good luck trading. After a brief break, Tasty Live programming at night continues. Ilya Spivak is up next with Macro Money. See you there.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at Tasty Live.
I'm like the Tupac of economists, going out on top. And will I ever really be gone? Say bye to Ben Bernanke. Cry your eyes out past the hanky. Gone from the Fed, but still looks swanky. Bye-bye, Chairman Ben Bernanke. Ben Bernanke, Happy New Year. Ben Bernanke, glad we're through ya. Sayonara, Mr. Yankee. Closing bell tolls for Ben Bernanke. Now, say hello to Janet Yellen. New blood, maybe start some selling? All around the world like a market Magellan. Hello, Janet Yellen. Janet Yellen, Professor Shady. Janet Yellen, new chair lady. Welcome in the new Miss Yellen. Different from the old, there's no telling. And I'm out, like Tupac, in a peaceful transition.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
I started trading around 2018, as soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic, and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets, is the biggest takeaway. And that's kind of just the overarching principle I follow.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
The beauty of Thinkorswim was that we were different. From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to Tasty Trade. See how it pays to have friends? Terms and conditions apply. Tasty Trade.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
The market's mostly lower as we start the week after last Friday's bloodletting. And it's a quiet week on the macro front. So what we're going to do here is try to unpick what's gotten everybody so spooked all of a sudden, what it means going forward. This is Ilya Spivak, head of global macro here at Tasty Live. You're watching Macro Money. And the question that is in front of us once again is whether we need to be worried about recession, because that is precisely the level of fear that seems to be permeating the markets here as we start the week here in the wake of what we saw on Friday's set of numbers, as well as, of course, on the price action that resulted. So let's first and foremost take a look at how last week shaped up across major markets and ground ourselves in that evidence, and then see what all this seems to be about. We can see here, bad week last week for stocks. S&P 500 down 1.7%, NASDAQ off 2.3%, yields down across the board, heavy move lower in excess of 1%, both at the long end, the 10-year, and the front end. The 2-year crude oil also lower for a second consecutive week, down 0.5%. Bit of a hodgepodge for the dollar, but probably the most critical bit here is the yen with a strong rise of 2%, and gold nearly pacing that with its own rise of 1.8%. Now, clearly, there is a thematic narrative that emerges here, and it is one of negative perspective on risk-taking in general, on risk appetite as a whole. And that's the kind of thing that happens when the markets get worried about global growth dynamics. So stocks are down. Bonds are up. That is to say, yields are down. That pullback in yields giving support to the typical and usual suspects, gold and the yen, both of which tend to benefit when yields are lower. The euro somewhat neutral here, but of course we were going into German elections this past weekend. They've since occurred, and we'll see how the coalition building proceeds from here. But the overall story, Bitcoin included, with a loss of 3% last week, is of the markets becoming more defensive, and with crude oil falling in line with these themes, the essence of the worry seems to be growth related. Now, this is after some very sobering economic data that came out on Friday. What we find here is the latest update on U.S. growth dynamics from S&P Global's Purchasing Manager Index survey. What we find here, first, the good part, manufacturing picked up a little bit of steam. We can see here the red line tracks that sector. It rose to 51.6, a very small rise from January, but nevertheless, a bit of acceleration. That was hardly the story, though. The main issue came from the service sector, the much more dominant part of the equation. In fact, you can see that manufacturing here sort of moves onto itself for the most part, but the overall composite index that includes both manufacturing and services looks almost identical to the service sector line, and that's, of course, because the U.S. service sector is close to 70% of the entire economy and close to 80% of employment. So clearly there is a disparity here, and services is the more dominant part of the story. What we see is actually rather shocking. The service sector shrank for the first time in over 2 years in February, looking at this data. As ever, it operates on a logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. The number for February here on the service sector, 49.7, that is to say below 50 and pointing to contraction. The composite number, as a consequence, 50.4, just a sliver above utter standstill, and the weakest performance in 17 months. So the U.S. economy here clearly showing signs of significant unraveling at the start of the year. Moreover, if we look at the index tracking forward-looking expectations within the data, it is looking ominous. At the start of the year here, we can see a brisk drop in forward-looking expectations for where purchasing managers expect things to go from here. Now, we're not in contraction territory yet, but as it stands, the level of confidence about future output has significantly diminished. And indeed, if we look at the bottom line here for what is being reported, we can see why. On the service sector side, and more generally, we can see what this cites is growing concerns and uncertainty related to federal government policies as a reason why businesses are turning defensive, and so new orders growth is weaker. Business expectations, as we just saw right here, are slumping. The other still more defensive beat here is on that uptick in manufacturing. As we just saw, this was a bit of a bright spot, even though it didn't really change the overall result, but maybe it wasn't as bright as it seems. Surveying suggests that the upturn in manufacturing was at least in part linked to front-running of tariffs. That is to say, importers boosting their activity, boosting their orders from abroad, expecting that tariffs downwind would make those same purchases much more expensive, and so attempting to stockpile at the lower levels, the lower costs now while they can. In parallel, of course, we've seen a similar kind of vigor in China, which has been the main beneficiary of this front running of tariffs. But of course, domestic demand there has remained anemic all the same. So this does seem to line up with what we're seeing in other data, and again suggests that what little offset from the manufacturing side there has been to the slump on the services part of the equation is indeed something with a short shelf life, at least for now. So why is this so important, and why is this so concerning? Indeed, much of the losses that we see here, much of these moves happened on Friday in the wake of these numbers. So what is it about them that is so very troubling for markets? Well, we've of course just seen the latest update on U.S. inflation figures, and there's really two big insights that we take away from them as pertinent to this conversation. Number one, to the extent that the rise in prices in a given sector reflects demand in that sector, which of course it does, the more demand there is, the more upward pressure there is on the price of stuff in the sector, because of course it suggests that people are competing for resources, and the way they compete is of course on price. So where there is upward pressure on inflation, there tends to be an outsized degree of demand, at least relative to supply. And so what you see, of course, is that overwhelmingly most inflation remains stuck in the service sector, which tells you just how important that is here for overall growth. In fact, it is absolutely critical because, as we can see here, there isn't much of a contribution from elsewhere. So the first kind of upshot here, you can see that of the total 3% inflation rate that we recorded in January, 2.62 percentage points came from services. So that we are seeing the slump that we are seeing right here ought to be a troubling sign, because of course that's where the demand is, as we can clearly see. The goods side, very much anemic. Secondly, we see that the contribution from this part actually cooled in January, whereas here it became less negative, which will of course be consistent, again, with the dynamics we're seeing here. And so when we look at the breakdown here, we can see that the contribution to CPI from goods actually became stronger in January, even though the overall levels we can see are a pittance, and it's because they became less negative month in, month out. But the main weakening, and of course the implied knock-on indication for demand, came from services. So that CPI report is telling us not only that services is still very, very important, but also that this very, very important part is the part where, despite higher than expected CPI numbers overall, we saw some weakness. All of which again speaks to the unraveling that we're seeing here. And of course, the implications for the overall composite numbers are troubling indeed. It goes deeper than that, though, because as we've talked quite a bit before on the show, the global economy is made up of effectively three growth engines: the US, the Eurozone, and China. And between them, they have 58% of global GDP. The remaining 42% are less impactful than that total suggests, because many, not most, are vendor economies that depend on demand from the larger three. So think Canada and Mexico with the US. Think Central Europe and Eastern Europe and Nordic Europe, perhaps even the UK with the Eurozone. Think Australia, New Zealand, big swaths of Southeast Asia and commodity producing Latin America and Africa for China. So we have a situation where the global growth picture is very much reliant on three core economies, and their weight, if anything, is understated by their headline contribution. If we look at what's been going on here over the past year or so, we can see that from the middle of last year, there was a very clear story of the U.S. outperforming. This is the composite U.S. PMI index from S&P Global. We can see this is the U.S. economy looking very, very strong up until these past two reports, January and now, of course, February. At the same time, the situation in China has been of slowdown. The situation in the Eurozone has been of slowdown. Now, we haven't seen the February numbers for China yet. That's next week. But the expectations are for numbers that are about in line with where they've been recently. And indeed, that's been the broader story in China overall. It's not that we're unraveling toward deeper and deeper depths of malaise, it's that the economy is essentially stopped because there is very, very little demand. In the case of the Eurozone, these latest numbers suggest we're just idling at this point, having returned only very nominally to positive growth. The upshot here is until the start of this year, there was a strong skew where global growth was expanding because the U.S. was holding it up, while everything else was flagging. With the U.S. doing this, that last line of defense appears spent. Indeed, if we look at the latest set of global PMI numbers, obviously this is for January. February is not quite there yet for obvious reasons, including the absence of China's data. So we'll get that update perhaps next week. But we can already see that for global growth, what this disparity has meant is that while the U.S. was powering ahead last year, the global average was actually cooling. And the reason it was cooling is because the U.S. wasn't really exporting their strength. Why? Because that strength was mainly in services, as we've just discussed, which is primarily serviced by domestic firms. Look at this outperformance here. Is it manufacturing that's doing it? Clearly not. And of course, that's the part where the U.S. Imports mix tends to focus on goods. And what do we see in the CPI numbers? Goods demand is weak. Services demand is strong. And that's, relatively speaking, to goods, of course. And that's mainly a domestic story. So the global growth pie has at best idled, if not cooled a little bit, over the course of the second half of last year, largely because the U.S. outperformance that we've seen has remained locked on shore. When we see these numbers for February updated, we're likely to see a very dramatic decline for global totals. And of course, what that would portend is a drop-off in global GDP. You can see here the PMI numbers tend to front run the big moves in the overall global growth numbers. And of course, the fear then is if you've kicked out the last leg of the stool by seeing the U.S. weaken, that global recession is not too far around the corner. You likewise have a situation suggesting that what we're starting to see in the U.S. has followed through. Note this U.S. Economic Surprise Index, which measures outcomes on U.S. economic data relative to forecasts, has dropped deeply into negative territory here. In fact, it is now at the lowest levels we've seen since August, September of last year. So clearly, there is scope for U.S. economic data to continue to underperform, therefore, for the cyclical implications to continue to filter through markets. And this is, of course, where all of this becomes tradable and actionable. We can see that Fed policy expectations currently envision just 65 basis points in rate cuts over the course of this year and through the end of 2026. That's 50 basis points for this year, 17 basis points for next year. Now, if we look at what the Fed itself projected back when it last updated these figures in December, we can see from 2024 to 2025, there's a move from 4.4 to 3.9. So that's a 50 basis point batch of easing here. And then from this year to the next, another 50 basis points in rate cuts from 3.9 to 3.4. Now, for this year, we're about there. We're only about 3 basis points removed. So the markets seem to be fairly aligned with where the Fed is at this point for 2025. We are still quite a bit light relative to what is expected for next year. As a matter of fact, we can see the sum here, 65 basis points through the end of 2026. That's about 35 basis points light of what the Fed itself is projecting. And so the markets are clearly not wholly consumed with recession fears or pricing in that kind of risk at the immediate moment. But of course, if this continues to develop as it has been, and there's deeper disappointments to follow, then this creates quite a bit of room for repricing, even just to get back to the Fed's baseline, never mind overshooting it. And so what we end up with then, as we look at our mix of assets, is a bit more of the same this week, perhaps, as we had last. More room for yields to move lower as bonds rise if we have indeed these cyclical concerns continue to find follow through. More room for the US dollar to weaken against that backdrop. And if indeed what we are concerned about is overall global growth, more room for stock markets to reflect this and for Bitcoin to reflect a larger risk-off bias as well. In fact, one of the few limiting factors on US dollar weakness, with perhaps the exception of the yen, might be an appeal of the dollar as a liquidity haven in this broader risk-off scenario. We've seen, of course, as we typically do, that when stocks take a big leg down, it is the dollar and the yen that tend to outperform the dollar because it is the most liquid destination for cashing out of riskier assets by virtue of being by far the most commercially used currency in the world. 88% of global monetary transactions are settled in dollars, according to the latest figures from the Bank of International Settlements. And the yen, because perennially low interest rates mean that when things are going well, the usual carry trade strategy has been to borrow cheaply in yen, sell that yen, and buy higher yielding assets. And so when those higher yielding assets turn inward and become defensive, the dynamic is to buy back your borrowed yen, so the yen tends to go up so that those loans can be covered. So the dynamics here seemingly setting up for a larger repricing toward a dovish Fed, a more defensive perspective on growth being the catalyst for that. Therefore, the tendency for the price action this week and the immediate term likely to look a whole lot like this going forward. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm on with Victor Jones for The Price of Truth on Tuesdays, on with Chris for Futures Power Hour Mondays and Fridays, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and opining at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is going to be back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
We're back. Tasty Crypto Show. I'm Ryan Grace. Of course, she's Shelly Van. Almost slipped up there, Shelly. Apologies. She's Shelly Van. It's like a tongue twister, you know. Tasty Crypto Show. It's Wednesday. We're getting through it. How you doing?
I'm doing really well. I'm excited.
Good.
Although I was just telling you off air that like I have that feeling that I'm forgetting something.
Oh no.
Forever. It's haunting me all day, and it's just been getting worse. Normally it's like, oh yeah, it was just something stupid, like, but this is just a lurker feeling that I can't quite shake. So.
Do you have to get gas in your car before you drive home?
I mean, no.
Groceries?
I've run through all the like logical things. It's something, I think it's like a task.
Have you bought your crypto today?
I did buy some crypto.
Okay, okay. Check the box.
Yeah. Grumpy Mike is here. Hello. Dino in the house. Shout out to the chat. But yeah.
Hopefully more people show up soon.
Hopefully more people. Yeah. Say what's up.
Some of the gang is here.
Some of the gang. Do we have a question for the chat? What am I forgetting? That would be, oh, is this live now, Mom? Hi, Mom.
I don't have a question. Do you have a question?
What am I forgetting?
Okay, yeah, that is a good question.
Lovely.
Jose, what up?
What
Sorry.
up, Jose? No, that's why we're here. Let's see. Favorite? We've done all the like sweet things. What about savory? Like salty snacks. Do you have a favorite salty snack?
Can it be sweet and savory? Because I love chocolate-covered pretzels.
Ooh.
But if we're just going pretzels, you know those ones that I think it's like, it was probably a genius idea by the company. I can't remember what the brand is, but they're these honey mustard like pretzel pieces.
Nibs.
It's from the same company that makes the giant pretzels, but these must have been like the broken ones, and then they just mixed them up.
Snyder's?
Yeah, that's it, Snyder's. Yeah, that's my savory snack.
Okay. All right, that's
And
a good
Chex Mix, I like that too. I like all the snacks.
You are a child.
I am, at heart, yeah.
Popcorn will be the death of me.
Okay, yeah.
All forms, cheesy.
You drench it in butter.
I do like some, buttery popcorn, but really it's cheese, the cheesy popcorn. Like I dedicate a hand to turning orange.
Oh, you have to, yeah.
This is
Make
my
the sacrifice.
Yeah, like, okay, I just won't touch anything with this hand until this whole session is over. But yeah.
Well, let us know, chat. What is your favorite savory snack? And, they're starting to show up now. Love that blob. Laura's here. That's your mom, right?
That is my mom.
Osborne Graves. Ben.
Sub-Zero.
Hell yeah.
What's up, everybody?
So before we kick things off, Shelly, we've got to talk about your new show. You and Dan launched a show, kicked it off this morning. It was awesome.
Thank you.
If everybody missed it, is there an on-demand recording? Can you go back and watch, or do you just have to tune in again on Friday?
You can. It is replayable on X and YouTube. So we will be streaming to Facebook eventually, but I forgot that we don't have 100 followers yet because it's a brand new account. So everybody here, please go like Tasty Crypto on Facebook because we will be live streaming over there once we build out that account a little bit more. But yeah, we will be doing the bookends of the week, Mondays and Fridays in the morning. And that was so much fun this morning. That was our pilot episode. Little hiccups here and there, but we made it fun. It's all part of being live and running lots of giveaways.
Yeah, I was going to say, you guys are giving away money on the show.
We are.
And crypto.
We are.
And NFTs.
Yeah.
And other prizes.
Uh-huh. It's darn fun, a variety show. We're going to have some really cool guests that we've already got lined up, some founders in the space, some really cool projects, and we're going to do some real-time exploration. It's going to be awesome. I downloaded or updated OpenSea today. That was a trip. Did it live on air, so it was like anything can happen. But it was really cool.
It's been a while since you were on there with all of your collection.
It hasn't. This is actually pretty new for that platform. Like I don't know when it went live. It's only been in the last maybe couple of weeks. So yeah, and I got to use it today because I was transferring prizes from my wallet. So there's new features in there that are really cool.
So if you're watching the show, you can win your NFTs, and you have quite the collection, I understand.
Yeah, I could be proud. But there's a hint of embarrassment because it's a little excessive. But I'm proud of my collection, and I'm willing to share it with new friends.
I love it. Well, I think I got to catch a bit of the show this morning. It is awesome. I highly recommend it. Get over to our channel on X or follow us on X. Get over to our channel on Tasty Crypto on YouTube. And the next episode is on Friday morning.
Yeah.
Looking forward to it. Beans. With Shelly and Dan. Shelly Van and Dan. You're pulling double duty here today. What do you want to talk about first? We can go to the market, which honestly hasn't changed since 6 a.m. when we put together our market update. We've got a lot of great questions that we've been receiving in the Tasty Crypto support inbox. So if you're using Tasty Trade, you kind of have a broad, we can't help you with your account, but you have a big, broad kind of crypto question. We're happy to help out. If you have a question related to the Tasty Crypto app or just anything crypto related in general, hit us up. We've had a lot of questions recently about kind of the connection between Tasty Crypto and Tasty Trade, a few questions on the app. So we can go and do a bit of a demo day, I suppose, but leave it up to you, Shelly. Guide us. Where do you want to go first?
Let's get some price action. Even though it's not exciting, let's get that over with. We got to know.
Yeah, let's do it. Let's jump into our slides really quickly. Have our performance dashboard just to take a quick peek at this. A couple things maybe stand out. Also, this is the same dashboard that was in the morning email. So if you don't receive that on Wednesdays and you want to, sign up over at tastycrypto.com. That goes for the Saturday email we send out as well. But yeah, just looking at where we are here, I mean, it's been pretty bearish. It feels like, at least for the majority of this month, as we're making it through. It's the 19th, but last few weeks, it's just been pretty poor, I don't know, boring, but just frustrating price action.
I've received some very concerned questions around Solana from people deep in the trenches, that maybe this is their first season in the trenches. So that can be alarming for those of us that have been around in crypto for a while. It's like that roller coaster of the whee isn't so dramatic. We're kind of like, yeah, we're going down. This happens. It'll come back up. We're good. Just long game view. But for anybody holding a big bag of Solana, what is your advice? Or not advice. We don't give financial advice. What is your opinion?
Yeah, in terms of how I think about it, I mean, I get where there's a lot of short-term selling pressure. A lot of what's happened that has probably made Solana interesting, and you look at some of the fundamental data that we've talked about that's been exciting around the fees that the chain is generating, the amount of new users, all of these meme coins or the tokens that have been launched on chain. That excitement has waned, and I think given what's happened recently with the Libra token, some of the other rugs, the blatant frauds that have kind of been launched, unfortunately, which, is not specific to crypto when we think about fraud, but, very quickly kind of bad actors emerge, and you've seen that on this platform. It's left a bad taste in people's mouth, and you've seen some selling pressure, but I think that's going to be short-lived in terms of we'll move past this. It's not like it's Solana crashing on its own. Everything has traded pretty poorly here. I think there's some macro drivers. it can't go up every day, obviously. You're looking for a bigger catalyst. Most of that is kind of priced in. There's a lot that's happening, not necessarily specific to Solana, but in crypto, when we look at institutional adoption, I think there's a lot of bullish drivers that are out there. But for many people, the time horizon is like overnight.
Yeah.
And so I get it. I don't think this is specific to Solana. And I think we also forget how volatile these things are until they go down. You experience more volatility actually on the upside, but it feels good. And you forget, how big those moves can be to the downside. So we look at Solana here at 170, 174, actually 167 if we have an updated price. It's kind of hanging out towards the bottom of a recent range, whether it holds on there or not. It is not trading very well. The other way that I would look at this is against ETH, against Bitcoin, and we can jump over to that in just a second. But yeah, you can clearly see here that it's been one of the relative underperformers against Bitcoin. But that said, not much has outperformed. Maybe bizarrely to me, Litecoin has outperformed, whispers of an ETF. Ripple, love it or hate it. I don't know what justifies the valuation, but that doesn't matter. That's been a fantastic outperformer. But Bitcoin Cash, Doge, ETH, ETH has been trading pretty poorly for a long time now, and we're starting to see that spill over into Solana. Bitcoin's held up okay, but I wouldn't be too worried about this long term. I don't think this is it for Solana.
Yeah. Jose loves Solana at this price.
There you go.
Sounds like he's buying.
Yeah, I've been buying some. I'm not putting everything I've got into it, but when you pull back to these levels and you look at something that was 280, 290 or so, we're about $100 lower than where we were just a few weeks ago. Maybe there's an attractive opportunity. Hopefully it goes back up. This stuff is, again, just very volatile. We forget how volatile it is until it goes down. So I don't know if that's helpful to anybody, but
I think it's reassuring.
Well, what we've seen is, this has been breaking down and we're getting these price momentum signals that we've gone from bullish to neutral on the weekly, and that's one step away from going to bearish. And when those things happen, you can see it here with ETH, maybe less of a reason to buy it while it's kind of trending lower. Doesn't mean it's going to stay there, but that's just how we use these signals. So
we have a question, JMG 1001, what justifies the SOL valuation?
Yeah, I think that, when you look at what's happening on Solana, what justifies any valuation here from a fundamental perspective, I would look at the fees or the revenue that's being generated on the chain, right? You have to pay a transaction fee to interact with the network to process the transaction. So if we see fees going up, that's going to be, pretty good representation of more users. Can that fee revenue be maintained if we're not seeing new meme tokens launching all the time? We'll see. But that's a use case that kind of popped up here recently. I don't think it's going to go away. There will be more use cases, but ultimately it's, what is happening on chain in terms of development activity? Does that lead to more utility, more use cases that then brings in more users that then supports this from a fundamental perspective in terms of revenue generation, if you think about it as a business? And when you look at it from that perspective, there's a lot of positive signs. Now, it doesn't mean that it's going to go up every single day, and we know that these things are wildly volatile. But if I'm looking at the fundamental picture, it looks pretty good. But at the same time, what matters today is the price, and the price action has been a bit disappointing. But just a month ago, we were $100 higher.
Right.
And maybe in another month, we could be $100 lower. That wouldn't be good. But my point is that these things can change in an instant.
Yeah.
So the one thing I will just kind of throw out there for anybody that's looking to kind of dig into some of this a bit more, DeFi Llama, Token Terminal, if you go to some of those dashboards, you can get a good sense of what we're talking about. You can see the fees. You can see TVL on Solana. You can see the amount of stablecoin trading volumes and activity on the chain. And if those things are going up and to the right, regardless of the price, I think it to some extent justifies kind of the future outlook.
Very good. So we have 10 minutes left.
Oh, wow.
We have to get to the demo, but we do have one quick question from Demi Moonbeam. What's the minimum amount of Solana you need to participate in liquidity pools?
I have actually never created any pools on Solana. You can do that through Radium or Jupiter. Given that I think the only thing that really holds anybody back is just the transaction fees, or with ETH, the gas fees. I look at Solana, though it's an L1, I mean, the economics in terms of the fees going to be similar to an L2. So I don't know. I mean, $100 is probably the minimum, or $50 is kind of an arbitrary amount, but I don't think you need much. Whereas if I'm going to do something on ETH, and it's definitely changed, but it's hard to create a liquidity pool even with $1,000 if it costs $50 to deploy the pool,
right?
Versus the fees you're going to generate off of that that capital. So with Solana, I don't know, $10 maybe, but your return in dollar terms isn't going to be that large.
Right. All right.
So hopefully that answers the question.
My partner in crime, Dan, is here, and he's saying join the Discord. Yes, join the Tasty Crypto Discord, please. That is where we are reactivating the Tasty fam, the crypto fam. Everybody's welcome.
I'm excited about that.
It's going to be really fun.
Yeah, we can finally support it, hopefully foster community in there. I know there were a lot of people early on that were showing up, and I apologize, we weren't at the same time, but we're bringing it back.
Bringing it back.
Dan's leading the charge, and you guys are doing a fantastic job of that, so I'm excited.
So what else do we have here? Expected moves, and then we can dive into platform?
Yeah, let's jump over to the Tasty Crypto app in just a second. But before we do that, let's just quickly take a look at expected moves here. I think this is good just to set expectations for the week, given where spot price is and volatility. If you've been following the show, these expected moves have come in quite a bit. So previously, and really around these same spot prices, we were closer to about an $8,000 expected weekly move for Bitcoin, and that's just a one standard deviation move. Expectation is that you're going to trade within that range for 2/3 of the time, basically. ETH has been a bit sticky at 250, but the tighter range here with Bitcoin is just a function of volatility absolutely collapsing. And that is something to take note of. Implied vol in here is actually, the updated vol is 49%. So we ran the numbers earlier at 51%. The realized is 33 on a 1 month basis if we annualize it. And when you rank that, and what we're doing there is just looking at, okay, the implied volatility of 51%, where is that number relative to all the levels it's traded at over a 3-month period, 6-month period, or a year? It's close to zero. What that means then is that these levels of implied volatility, option premium, what traders expect in terms of movement, are at some of the lowest levels on the year, certainly some of the lowest levels in the last 3 months, which is a function of just how wildly volatile it was with the election and everything that's happened in the past couple of months. So you can't read into that shorter time period too much, but volatility has come in a bit. Will it go back up? Maybe. It can go a lot lower. Just know that characteristically, this is pretty low for what we typically see with Bitcoin.
Mm-hmm.
So tighter ranges when volatility comes down, volatility widens, you're going to get bigger ranges.
Makes sense. Makes sense.
So yeah, that's where we're at with the expected moves. A little bit of the performance dashboard, but really, again, it's been pretty boring out there. Frustrating for both the bulls, and I guess even more so recently, if you're short the bears, it's not really going down either when we look at Bitcoin.
Yeah. Grumpy Mike, more users, as in some application for the coin generating the fees, or is it just more speculative buy-sell generating fees?
I would look at it as more users on chain. Are more users participating in the Solana ecosystem, on the Solana network, however you want to think about it, right? You have a blockchain that decentralized applications can run on top of. More users of those applications is synonymous with more users of that chain. Mm-hmm. And I think generally speaking, this is true of everything, right? If more people use Bitcoin, there's increased demand, there's limited supply. More people use ETH, Solana, et cetera, it should have a positive impact on the price. It's not necessarily going to be one for one, but if there's increased demand for something and you need Solana to pay transactions, it's part of the ecosystem, trading pairs are based in it, you're going to likely see the price go up.
Mm-hmm.
If people are shunning Solana because of something that's happened on chain recently, well, price is going to go down. But I think, again, that's temporary. The one other thing I would add to that is that there is a lot that's going on in the ETF space where it is seemingly likely that we're going to get a Solana ETF sooner than later. It seems as if we will get for sure a decision on the Solana ETFs that are in review right now. Hopefully they're approved, but that is another potential catalyst. So again, I wouldn't read too much into just the short-term volatility here.
Yeah.
I'm not of the view that this was it for Solana and it's going back to FTX prices. This is something that has survived the very worst of what we've seen thus far in crypto.
Okay, pressure's on. 4-minute,
I don't think we can do it. I think we're gonna have to kick it to another day. I guess we can show and talk about a couple things in the app. Let's do that.
Yeah.
So if we can throw the app up on the screen, and I think it's up there, but let me just double check. Yes, beautiful. So we've got the Tasty Crypto app here on the screen. This is for iOS and Android. And the one thing that I do want to answer, Shelly, is just to show everybody how you can connect this to your Tasty Trade account. Once you've connected it to your Tasty Trade account, you can transfer crypto that you have with Tasty Trade or with Zero Hash to the wallet address that you control here with the application. The new version that's coming out will also allow you to buy it right here in the app. Now, that will still be in your Tasty Trade account, but you can do it all with one interface, one platform. So that's pretty cool in my opinion.
Super swanky.
Here's how you do it. So this is already connected, but all you need to do, you have the Tasty Crypto app. This is on chain. This is your self-custody wallet. You want to connect it to your Tasty Trade account. This is assuming you've got crypto trading enabled, you've got crypto transfers enabled. All you need to do is you go to the menu and you're going to go to Tasty Trade. And I have previously logged in. So now I'm active. When I click on this, well, it's going to tell me that I'm already logged in. So I'm in here now. And now that I have the connection, if I go to click on add and I click on Tasty Trade, you can see the balances that you have here. It's going to take a second to load up. I know that this one at the bottom is the one that I have the crypto trading enabled on, and also the transfers. And so this is going to give me the ability to withdraw crypto. And the two assets that I hold with Tasty Trade right now that I can bring over to the wallet, so you can move over Bitcoin, ETH, and Solana. The wallet itself doesn't yet support Litecoin, Bitcoin Cash, or Doge, or Ripple, all separate chains, things that we can add. Primarily an Ethereum-based wallet. We do have Solana. You got L2s on here like Base and Optimism Arbitrum, and of course, Bitcoin. But what I hold right now at Tasty Trade is just ETH and Solana, so a little bit of each one here, not quite an ETH. If I want to move this over, I just click on it, and let's say that I want to transfer $5. So I can put in, whoops, that's 5 in ETH, but let's go 0.0005. So not quite $5, but $1.36 for this purpose. Let's go a little bit more there. So there we go, $2, review transfer. And actually, you know what? I can't open it up on this because I have my other authenticator on my phone, but we can walk through what this would do. You would go in and you have to have 2FA, so two-factor authentication turned on in your account for security purposes. Type that code in. If I had the ability to do that here right on the show, not prepared, apologies. But once I put that code in, it would take me to another screen, and then you just confirm the transaction, and everything else is going to happen under the hood, and your crypto will be withdrawn from Tasty Trade to the address that you control here, and you'll see that balance eventually after that occurs. If I get all the way back to the home screen here, you'll see that Ethereum balance then update. You can see that in your activity. You can then trade that for other tokens.
Yeah, you're on Party Island.
You are on Party Island once you move that ETH over. Yeah, and so there's a lot that we're working to improve the experience, build better bridges to Party Island. But today, when you're logged into your brokerage account with Tasty Trade, you have crypto enabled, you got the 2FA turned on, you got the transfers taken care of. But you've gone through that process, and you only really have to do that once. But once you've done that, then you're free to move crypto back and forth, use the exchange functionality that exists via Tasty Trade and Zero Hash. But when you bring that, that crypto on chain, you can stake it via Lido. You can create a liquidity pool, Uniswap, or directly in the app, you can swap it. And so if anyone isn't familiar with how this works, and this is across multiple blockchains too, it's not just on Ethereum, but you can see here some of the different token balances that I have. Let's say that on the Base network, jumping from L1 to L2, I have $100 or so in USDC on Base. if I even want to buy more ETH on Base or another token, Virtuals Protocol, for example, one of the AI launch pads that we've talked about, you can do all of that right here directly in the wallet. So if I wanted to swap all $110, I'm going to end up with a little bit less. There's a little bit of slippage, there's a little bit of a fee in here, but this is a way that you can swap, and this is all happening directly on chain, which is cool. This is outside of the brokerage ecosystem. If you want to move it back into your brokerage account and then subsequently back into your bank account, you just have to deposit it back at tastytrade. But once you move it out, you can do whatever you want. Your keys, your crypto, right?
That's right.
Party Island.
Party Island.
Wasn't quite a full demo, but I think we
good.
covered a couple things. And again, that's how you would go in and just connect to tastytrade within the Tasty Crypto wallet application. There's a lot more coming soon.
So much more. We almost spilled some very big beans on the show this morning.
Oh, no.
Yeah. So
You're letting the secrets out, huh? That's okay.
it's the point. Beans.
Yeah.
Spill them.
What did you, I mean, I guess
Well, yeah, I can't really tell you, but
new features, new things coming to the, what were you alluding to? Okay.
Yeah. Tasty traders specifically will be very excited.
Ah, gotcha. Okay. I think I know what you're talking about. Yeah. Shelly and Dan are cooking up some really cool stuff in the cave. We should get that out, I would imagine, in the next couple of weeks.
Yeah.
So some cool things there. Can't really speak to it other than saying we're doing cool things. But on the wallet app side, there should be a new update that goes to the iOS and Android stores this week. And then next week, presumably, it's approved. It's available for download. That'll have the ability to buy crypto. Some really nice improvements. I know we've had a few bug reports recently, so thank you everyone for that. We've got the fixes in place, and some nice, updates to the swap, and then that watch list feature that's got a really cool new news component. So we'll do a more in-depth demo once that's available.
Yeah.
But I think we've run out of time.
We have. But that was a good speed round. Well done.
Yeah. Sorry we spent so much time just talking about the market not moving.
That's fun stuff.
Next time. Well, Shelly, as always, thank you for coming on the show. And again, if you have not checked out Beans, get over to the Tasty Crypto YouTube channel, subscribe to the channel. The show is every Monday and Friday, 8:30 a.m.?
9 a.m.
9 a.m.
Central.
9 a.m. Central Time. It's an awesome show. It's a lot better than whatever I'm doing here with this. So make sure you check it out. But I will be back next Wednesday, so I'll be off on Monday. Shelly will be back with Beans on Friday. Until then, I'm Ryan.
I'm Shelly.
Peace.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade. What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
Sadnov, can you show him your Valentine's Day present? Please, this is the moment when Sadnov was happiest. There you go. That's Sadnov when he was eating his Barnaby's pizza. I made him a pillow.
Oh, nice.
I spoke to your wife last night. You know, you got to stop just thinking about yourself, Sadnov. That's soon to be in the store. Your wife wants you to bring it home for the grandson. Hand to God, that's what she. I have it here. I'll send. You want me to send you a screenshot? And I said, would you like me to take this home for you? And I said, no, not me, the pillow. And she's like, oh, I thought you liked me, but sure, I'll take the pillow for my grandson. I think he'll enjoy it. I go, I don't know if Case is going to enjoy it, but the baby will enjoy it. I had no less than a half a dozen people from our firm say, I love that pillow. Where did you get it from?
Oh my God, you're so full of crap.
People love it.
I'm going to do a buddy pillow.
You want a what?
There you go, John. How cool would that be?
You should do a buddy pillow.
Can you see this?
Yeah. What is it?
I made this. We went glass blowing over the weekend. I made this.
Oh my God.
Oh my God, are we at show and tell now? What am I, back in third grade?
Beth, thank you. See, I'm very proud of it. It sits on my desk.
You went glass blowing?
Yeah. When was the last time you did that, sir?
I would never do that.
Guarantee you, if the missus said to you, we're going to go glass blowing and then hang out, there you go. You're blowing glass left and right. What do you got? I love glass blowing. Okay?
You become the best glass blower this country.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Oh, yeah, it is Monday, February 24th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast. A little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And good golly, Miss Molly, there are a lot of incentives and a lot of people trying to govern this world, whatever that means. More on that later. But for now, we should say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be a part of Bing, this little chat box over here is only one place to do it, and that's on YouTube's the evil Google YouTube. So head on over there. If you're a part of that ring, one of these days I'm gonna get this operation streaming on Rumble. But for now, it's exclusively Google YouTube. Head on over there and go to Tasty Live's channel and
hop in the chat, start moving those phalanges, start moving those metacarpals, bash your face into the keyboard if you want to. Just make sure you're typing in random-ass characters into the chat so we can spoof that dumbass Google algorithm into putting as many people into this chat as possible and save the world, enlighten the world. I don't know, deprogram the world one view at a time. Speaking of, by of and for the people, we should say what's up to the people. Shout out to everybody that's already in the chat. Hope you guys had a great weekend. I did, kind of. Felt a little bit better. My daughter turned 3 years old. And I'm looking at these children, 5 and 3 years old. And any of you parents out there, you know this. There's this moment when you have a child. You look down at him and you go, one of these days, this little thing, first of all, it's crazy to just that holding of him. And you go, one of these days, this thing's going to like walk around on its own. And then I talked to my wife, one of these days, this little thing is going to talk to us. And then do you have the second one? You're like, one of these days, these little two things are going to like talk to each other. And then to sit down, like we got a 5-year-old and a 3-year-old. And they're just talking to each other, singing happy birthday. Like my son, he went up on stage, grabbed a microphone, sang happy birthday to his sister. And I'm looking at this like, what is life, bro? It was a good weekend. Anyways, glad to be back with you. Hopefully you had a great one as well. I'm going to say what's up to all of you. Lone, what's going on? Absolute Beginner, Soul Train, Catan, Brian Watson, the chat, the YouTube gangster, Grumpy Mike, what is up? V-Dub, what is up? Matthew, Carl Jung, for bet or fold. Love that. Victoria, how are you? Great to see you. I think I might have skipped some people. Hopefully I did not. But Gapper X, V-Dub, all of you, big digital hug, my friends. Great to see all of you. Hell of an end to last week. Hell of a start to this one. What are you guys saying? Saying what's up to each other? I'm telling you, I love this group of people. What a great way to end a trading day, if there ever was one. Victor Jones, are you going to go to Fort Knox for us to live stream the audit? Let me do this. I got a question to email. I don't normally do this, but let me do this. I'm going to answer it on air. I'm not going to say who it's from, but who knows? Maybe this person's listening. I was listening to First Call on demand on my morning walk today, and you were giving Tom a hard time about him declaring Ron or Rand Paul to be a whack job. I have to say I agree with him. And I didn't form that opinion because of the media I consume, but by listening to the words coming out of the guy's mouth. Either Ron or Rand, but Rand is worst. Okay. That's neither here nor there. Put that to the side. However, you guys were talking about the Fort Knox kerfuffle, and you said something to the effect of restoring trust in government institutions. Were you just poking the bear for fun, or do you really believe that there was a lack of trust in the gold repository? Seems pretty out there. So on First Call, I did actually say I was here's my thing. We elect representatives to do, in theory, a democracy is an elected, we have elected representatives to do our bidding or to represent us. And I believe, I think there's not as much transparency into those decisions, the incentives that guide those decisions. It's structured in a way that gives a lot of leeway to those elected representatives. And I think the more, I'm in favor of more single issue voting. So you can't hide, if you vote against something, you can't hide behind some pork that was in the bill as the reason why, or vice versa. I'm in favor of more transparency in terms of payments. Do I think Fort Knox is empty or light on gold? Let me say this. It's not the wildest conspiracy theory. There is a reason, people, that we went off the gold standard. It's because France called us on our bullshit. There's a reason we had to leave the gold standard. So Do I think it's the wildest conspiracy theory? No. But do I would assign the probability as a low probability. Let me say it that way. That might make me naive to some. That might make me a conspiracy theorist to others. I would say I assign a low probability of that number being materially off. However, my point wasn't about there being a lack of trust in there being gold in Fort Knox. I actually think the opposite. I think a lot of people just believe what you tell them. And I think there's a lot of people that are now, because they feel that they were either lied to or misled on key issues that have happened over the last 5 years. I think there are people questioning everything, even things that shouldn't be questioned. So do I think Fort Knox should be audited? I don't know. I think we got a lot of things that we could probably focus on. That seems to be a bit of a distraction. I don't think there's much value in that. In fact, I think if we find out we've been lying about the amount of gold in Fort Knox, it's actually I don't think it benefits us in any way, shape, or form. In other words, like Singapore has a repository or reserve, and for national security reasons, they don't tell anyone how much is in that reserve, their gold reserve. They don't even tell the U.S. citizens. So I don't think it actually benefits us to find out that we are lying to ourselves in that particular instance, and it probably will have disruptive forces to markets. I don't think it's, but I think if all is on the up and up, it's a bone to throw at people who are starting to question everything. That like, okay, maybe I'm being a little bit too mistrusting of our institutions, and I think it probably settles some people down. That was my point. So, I don't know. What do you guys think about auditing Fort Knox? To me, again, we have so many things that need to be addressed, in my personal opinion, in America. I do not think this is on the top of the list. I don't think it's on the top of the list, but I think it could be something you just give it to Ron Paul. Say you create a commission of people you trust, and you go do this thing. Yeah, why not? I don't think it's number one on the list, but I'm not mad at it either. Thanks to all of you saying happy birthday to baby girl. Blessing to be a parent. It really is, man. And that's one of these things. I'm going to start off pissing off people. It doesn't matter. That's one of those things you don't get it until you do it. Like when my wife and I have this thing when our friends come up and they tell us they're having children. We like, we do the thing. Oh, that's great. Whatever. And then we, at night, when we lay down in bed, we go, idiots. Like they have no idea what's coming. They have like this blind sense of optimism, and it's great. It's the greatest thing. It's the hardest thing at the same time. It's impossible to explain the duality of that to anyone. You just have to experience it. Catan says there's only one gold bar and an IOU note. It's all all of this stuff is just a big IOU game. We've made IOUs we've made IOUs money. We've made debt money. So yeah. People can't even tell AI fruit picks, but will believe Fort Knox video. Long single issue bills. It'll never happen. We love pork bellies, Victor. Low probability, but I am scared, to be honest. What happens if they find it's way light? I agree, but I don't think they're not going to do it. It doesn't make any sense. Mark to market the gold, Victor. Wait till your kids have kids. Catan, you just hit me with a. I hadn't even gotten to thinking about that. The next thing I thought of was like the sports thing. And I thought, I think we just had high school graduation. One day these kids are going to graduate high school. Anyways, all right, let's go. Let's talk markets. E-mini S&P, my babies, 6,000, almost on the dot, 5 points for good measure. S&P was down 0.5% today. You already know this, but I'm obligated to do this at the open of the show. Money itself is an IOU, says Peter. Correct. The NASDAQ down 1.5%. The Dow Jones up 8 basis points. The Russell down 0.4%. So another little continuation day. They tried to pull the okey doke on Sunday's open, saying all was well. And I think Tom had a really good call, not only for February expiration, but also that the likelihood that they probably goose them, and then he said at some point tomorrow they will be down. A very nice goat call. And today we're right at 6,000. And if you were to sort of look at, sort of back out of the just horrific data that we got on Friday and the changing narrative and the stagflation drumbeat that's starting to grow louder in the mind of the market participants who are now discounting some of these instruments, if you take away all of that stuff that's now starting to change people's feelings, right? If you take away all that, where are you? You're exactly where you've been for 4 months, people. That's the reality, is that you've been 6,000 plus or minus 200. That's where you've been for like the last 4 months. And the narrative's been crazy optimistic, and it's been, oh my God, AI is over, DeepSeek is everything. It's been on both sides of that coin. But the reality is you're 6,000 plus or minus 200. And if you think that way, perhaps you're a little bit less fearful of a 2-day sell-off. And I'm not saying there's not reason to be cautious or fearful. I don't know that we should ever really be fearful, right? Because blood in the streets just means opportunity on a long enough time horizon. I'm 38, coming up on 39. I didn't really process that. This is going to be my last year in my 30s. Anyways, that was enough for a little mini midlife crisis. Anyways, the point is, on a long enough time horizon, I'm looking. I could go for some distress assets. No offense to all of you who might be needing to sell or liquidate in a jam, but I certainly wouldn't mind buying up some depressed assets, both of the equity and real estate variety. We'll see. I don't know that I'm gonna get that chance anytime soon. But I wouldn't put out of the cards that the first 6 months of this year is going to be a lot rockier than I think people are pricing. But that data last Friday was horrific. We didn't get a chance to talk about it, but PMIs were bad. Services PMI came in under 50 in contraction territory at 49.7, and that, my friends, is the economy. So the fact that most people thought we were going to be in not only in expansion territory, but well into it. The consensus was that the services PMI would be at 53. This is how badly it missed. The consensus range was 52.7 to 54.5. So people were optimistic. And so you get a crazy adjustment, and it's likely because people were so far off about what their expectation was on this reading on the economy. It came in at 49.7. So if you know anything about reading those types of indicators, anything above 50 is in expansion territory, anything below 50 is in contraction, and the further you are below 50, the more pronounced that contraction is. So 49.7 spooked some people. Manufacturing index was a tad bit better than people had expected. It was 51.3 expected. 51.6 was the actual. And so the composite index came in at 50.4, just eked above 50 number. But services, my friends, is the economy. That spooked some people, I guess. I don't know. Some people are worried about some coronavirus or bird flu stuff. Here's my general rule of thumb. put on your aluminum foil hats for me for just a second. I have a couple of wild indicators, sort of like non-traditional indicators. I know people like to look at charts and like to look at moving averages, whatever. But my pattern recognition goes off on different stuff. My pattern recognition is when I see Scott Gottlieb on TV more than once in a week. If he's doing like 4 or 5 hits in a week, I start taking vitamin D supplements. He's on Scott Gottlieb. If you don't know, he's a former FDA, the former head of the FDA, FDA commissioner, who is now, I think, what was it, 2016, 2021, 2016, I think, and was appointed to the Pfizer board. So you know that whole revolving door thing people are kind of upset about. He's like the poster child of that. And so, yeah, he goes on CNBC a lot. He goes on the Sunday shows a lot. Somehow he's become sort of like the listen to me expert when it comes to what to do about like bird flu or, novel viruses. The guy who sits on the board of Pfizer. No conflict there. Anyways, I start seeing him on TV a lot. And I think, what are healthcare stocks doing? Speaking of which, Moderna took another bath today, down 4.5%. What is cheap can get cheaper. But I mean, we started looking at it. All it's doing, there was a little like post RFK confirmation rally. But that low was 29.25, which I think we hit on the day of the confirmation of the day after. And we still haven't gotten back down there. So we're still working. Let me quick read what you guys are saying. I'm guessing I'm talking spicy, so maybe you guys have some funny comments. Let's see. Mondays and Fridays since January are down day. Monday and Friday since January are down days. Don't do that. Don't do that. Even Chris mentioned that point today. Don't do that. I'm telling you. That will murder you. Don't do that. That's like, I'm telling you, don't do that. If I said, that's like saying, flip a coin on Mondays and Fridays and then start writing it down in a notebook and then start noticing that on Mondays and Fridays, ever since January, I get heads on Friday. Are you going to bet heads for the next one? Don't do that. I think most seasonality is kind of bullshit. There's some that is structural, given sort of tax reasons and things of this nature. There are some sort of structural flows that take place at certain times of the year. But I'd be real careful about doing like their Mondays and Fridays. I could go for some elevated VIX, says Douglas Smiley. You're only as old as you feel. Some days I aged 10 years. That is true. These days I'm feeling a little bit younger. You know what I think I'm going to do? I think I'm going to box again. I think I'm going to try to get in like maybe a white collar boxing. I say that now, but that's only if my body holds up. We'll see. She's trying to roll over. You think so? Says Gapper X, talking about the market. Likely, she's trying to roll over. It does seem weak. It certainly does seem weak. And I think one of the things that, we're only at 116 in the bonds. So it's really hard, I think, for most people to look at what's happening in the bonds with any excitement. We got to a low of 110. We're at 116, but I think generally people are expecting higher yields. So nobody's really talking about that bond rally with any enthusiasm. However, my friends, to give you the Lee Corso, not so fast, my friends, look at what, again, if we're looking at the yield curve here, I like to plot several points in time on the yield curve so we can just see how it's moving. Sometimes, for all of you that don't watch bonds tick for tick, you're not watching the 2-year and the 5-year and the 10-year and the 30-year. maybe, just seeing those prices on your screen, you can't create the visual in your mind. I'm a very visual person, so sometimes I think, especially if I'm going to trade bonds, I like to not only trade up or down on bonds, I like to trade the relationships, the 5s and the 30s, the 2s and the 10s, all that good stuff. And so that means I like to see the image of the curve. Anyways, the red line is when we started the cuts back in September, the jumbo 50 basis point cut. The green line is the cut that followed in November. The blue line is the cut in December, the last one. The yellow line is where we are now. And you can see I've been showing you where this line has been at certain points in time. If I go back to the end of January, you can see we were elevated and the short end started to drop. Now, all the way February 24th, the whole curve is dropping. So when they got serious and they stopped cutting rates, regardless of all the inflation hoopla, and the reaccelerating inflation hoopla, the curve is dropping. And I think that's sort of an important note. I completely get that the inflation numbers look bad. They don't look great. And I completely get that the growth numbers as of Friday, because it wasn't just PMIs. I think home sales were dog, you know what. It was just bad numbers across the board on Friday. So if sort of on a very short-term basis, growth doesn't look great and inflation looks like it's reaccelerating. Those, my friends, that's moving in the direction of something called stagflationary conditions. And if you go back maybe 2 or 3 weeks, I can't remember, but I had a conversation with, I think it was Chris Vecchio, and I asked, because this was inevitable, stagflation is so inevitable, that if we hit a growth slide, like there's only two ways, there's only two paths here. We hit a growth slide, and we got to print. And it sort of, we create this spiral because printing, unless we do QE, you just see higher and higher rates, which creates more difficult business conditions, which then creates slower growth. It could get real nasty. So there's a stagflationary path that we could end up falling into, or we could find some miracle of growth or productivity which allows us to run these deficits, and we sort of grow our way out of this thing, which it doesn't come along very often where you find just these miracle pockets of productivity, right? Maybe you make the case that China joining the WTO and just farming out a bunch of these jobs globally, we found a new, more productive, I think from the supply side, more productive labor force at a cheaper cost. But that doesn't happen very often. So anyways, my point is, even with the inflation scares, sort of these growth scares seem to be suppressing in some ways or offsetting those inflation scares, which is at least easing the curve for now. And the fact that the Federal Reserve at the same time is sort of hinting that, they're not going to be so quick on the trigger finger to lower rates anytime soon, all that's combining, it seems like, to ease yields. Speaking of which, we'll look quickly at the probabilities, where we go from here. There is still a high probability of a cut from the market's perspective in June. It looks like the market is expecting them to hold then the next meeting with another cut in September. I don't know why it took me so long to come up with that. In September. So 2 cuts for the year. They've moved that second cut up. we flirted with 2 cuts in the past. A lot of the times that second cut only ekes into the back end of the year. So not only do we have 2 cuts fully priced, but they've moved it in to September. Again, that is sort of the market's way of hinting at sort of slowing growth conditions that could make themselves very apparent to the extent that it would give the Fed cover to continue to cut. Now, let's also remember, this is the same damn market that coming into 2024 like priced 7 cuts. So remember, the market priced what it wants, not always what it expects. The market price is what it wants, and we are used to, if not addicted to, cheap money. And so I think take that with a grain of salt. We've been all over the board from 1 to 3 cuts. But one of the things I did say when we came into the year, I think we only had 1 cut price at the time, that if I had to take the over or under, I think it's hard to imagine us getting more hawkish. And I'd probably price that the market moves to the over. And we haven't moved much, but we have started to move in that direction a little bit. Tinfoil hat time, my favorite. Did you guys like that Gottlieb indicator? I'm telling you, it's not bad. Whenever you start seeing Gottlieb, you know you've got something. There's probably some therapeutic company that's up 20%. Like last time I saw him, what is it? There's monkeypox. Saw him again, bird flu. Saw him again this week, and there's something popping off in China, some new potential virus. I want to talk about COVID so badly. I self-censor myself all the time. One of these days, it's going to be my last day, and I'm just going to let it go. Those that don't remember history are destined to repeat it. Amen. Home builders are our canary in the coal mine. They have been, bro. They have been, and we had ourselves on the back a little bit. Kind of saw it coming with the home builders. How can we have stagflation with the bigliest brained leader? Yeah. To me, I don't really. I get that. I know you're joking, Grumpy. I think. We give sometimes we give the president a lot of credit they don't deserve, and sometimes we give them a lot of blame they don't deserve. Some of these things are all the setup. And you can't escape the setup. Yeah, it's like a president alone can't steer a $20 trillion economy away from stagflation if the setup is there. And you could go back years and you could listen to somebody like Jem Carson talk about the likely stagflationary conditions we were going to head to, and that's before you know who's going to win the 2024 election, because it just doesn't matter. The setup, the incentives that guide that setup are kind of all there, and it doesn't matter who pushes the domino. It's the fact that the dominoes are all set up to fall in a certain direction. The likely probable path is set up a certain direction. See, I don't know. That's kind of my thought. I don't, if I eat something I don't like for dinner, it's not the president's fault type of thing. You know what I'm saying? Oh my God, I forgot Vic's legendary monkeypox call out. That trade was epic. Miss DiMartino says foreclosure waves incoming. They are, bro. It's just, I don't get how people don't see it. Like, what do you think is they're laying off people in droves. And now that we're laying off government employees at 10,000 a clip. And housing is unaffordable. Yeah, what do you think happens next? You need the outlier. Like we're by the middle of this year, we need an event that allows us to change direction and add liquidity. But you can't just do it and create inflation for everybody. You need to scare them and make them beg for the easy money. That's how this works. They never force anything on you. They make you beg for it. You beg for the thing that comes that kills you. I'm sorry, that was a little dark, but that's true. That's a little lesson I've learned. That we always ask, the majority of us always ask for the thing that ultimately is our own undoing. And then we realize in retrospect that there was the wrong thing to ask for as the majority. All right, I'll keep going. Absolute Beginner says recession. I think it's like no one believes this. And the data doesn't show this. But I have this sort of cheeky thing that I post and pinned on my X account, which is the only people or the last people to know we're in a recession are those that know what the NBER does. And it's a joke, but I kind of believe it. And I believe that our economy has been slowing down like for almost a year now. You're crazy if you think we're at the same pace that the economy's growing at a pace for the last year. And there was a time when we just generally accepted that that a slowdown in growth was a recession, but because we've become so sensitive to words, we can't use that word. So yeah, we're in a growth slowdown at the moment, and we're redefining what a recession is, I guess. But it's also these types of recessions or these types of growth slowdowns are wild because markets at highs, your dollar's getting trashed and going to continue to get trashed. Growth is high but slowing. It feels weird. It doesn't feel like the great financial crisis you just went through. And most of us weren't, in my age bracket anyway, you weren't around for a mild recession. When they come, these things come hard. Pause. When recession comes, it's like a big deal. Previous generations have gone through periods of mild recessions where you can have a couple of quarters, 3 quarters, something like this of growth slowdown, and then you recover. Psychologically, it seems we're not capable of doing that. So we just pretend it's not happening. But the other thing I have to understand about myself, I have a naturally cynical point of view. Some people are like, oh, I want to be more positive, or I'm, whatever. I am naturally cynical, and I found the only job where applying that instead of trying to change myself is actually probably more beneficial. Being cynical, seeing somebody's negative incentive, and then planning or trying to mitigate around those risks, it probably plays in some way to my benefit here. So my character flaws, in some small ways, can be utilized as a benefit only in this world and nowhere else. VIX at 1898, which is interesting in the fact that we didn't really do much more damage to the upside in vol. We spiked up to about 20 before easing today. Still at 19, that's historically elevated. We're getting into what would be a really, really interesting area between 20 and 22 to look to start harvesting some of that premium in instruments that you want to own. If we're not there already, I do think you're at a 50-50 shot, right, at the equity index level again, 6,000 plus or minus 200, you're at a 50-50 shot. You're probably not getting great entry odds, but you're not getting the worst. You know, you weren't buying the S&P at 6,200, but sorry, you weren't buying the S&P at 6,200, but you're not getting a discount for entry. And I sort of think I would love to see the market I would love to see us put everybody sort of at a decision point right around 5,800. Because your bulls are going to want to take a stab, and your bears, you know, the bearish participants. I always hate framing the market as like this battle between bulls and bears, because I think that's a stupid, very like intellectually, it's a very unintelligent way of looking at the world. But if I were going to frame it that way, from a bear's perspective, you know, if you crack 58, that's sort of your line in the sand. It could get ugly from there. And sort of from a bullish point of view, you know that if this is your range and you hold, that you're getting the cheapest possible entry on that range. So I would love to see us put the market to like a real test at 58. I don't know if we're there yet. But we need people to buy bonds. We can't print without people wanting to buy bonds, which means the incentive structure is towards allowing this thing to continually slow down a bit. Because you get growth going crazy, inflation going crazy. Didn't I just read that Japan's CPI numbers were like 4%? Their interest rate is like 0.5%. Or something like this, 0.25%, 0.5%. How do you fight it? Like, does anybody? This is like the farce, you know. A couple of years ago, if you would have said central banks are gonna abandon the 2% target, people said, "Oh, you know, you're crazy. You're a conspiracy theorist," or blah blah blah. Show me a 2% inflation rate globally. Point to it. Can you find one? I know there's a handful, but like. Our central bank is talking as like we need to make additional progress towards 2% or something like that. It's like, bro, it's going the wrong direction. We're going towards 3% here, looking for additional evidence of cooling. The evidence is showing you the exact opposite. The evidence is showing you we've got a problem, and you're supposed to be doing something about it. But we're not going to do anything about it because you want to know why? Because we are taking on a position, and every time the Federal Reserve takes on a position, they end up wearing it. And the position they're taking on is that this spike in inflation will take care of itself, and it will go away, and they don't have to move rates, and we are all gonna suffer for the stupidity of this of the Federal Reserve trying to trade. It's like sorry. I hope I'm wrong. But literally every time they take a position and they think something's going to go, they have one job. And I guess it's a dual mandate, and they are literally opposing jobs. So, but it's like stable currency, bro. How are they doing at that? It's an easy job to dunk in the Fed, so I wish I had something more interesting to say, because I do not understand why don't people care? That's my bigger thing. It isn't what they say or what they do. It's the fact that people still don't care. You don't give a shit that inflation's running at 3% and nobody's asking these guys difficult questions. Nobody's looking around going, first of all, why is it even 2%? There's nobody that can credibly answer that question. Maybe it was at one point because the gold supply increases at 2% globally. Maybe that's why it was modeled that way. I have no idea. And I don't think I've ever been able to ask somebody that could answer that question. So first of all, I don't even know why it's 2%. But why do we keep getting these piece of papers that say in 2 years we're going to be back down at 2%? And I keep having to deal with we all keep having to deal with 3% inflation in front of the 3% official inflation. The reality is like 10% to 15%. Nobody cares. I don't get it. All right, I'll move on. Everyone just gets desensitized to this stuff, and then they go, okay, this is the way it is. I'll just deal with it at this rate now. And then we all get used to 3%, and then we run into the next problem, and then it goes to 4%. Creature of habit, I guess. All right, the euro. I'm sorry, I'm complaining a little bit. 104. 104.73. God, why is this loading so slowly? Bitcoin down 11% since inauguration. Yeah, I was just noticing, not just Bitcoin, man. A ton of risk assets, like riskier side of it, like a ton of beta is down, like quietly down significantly. Let me see what you guys are saying. Pause for a second. Preach. Why should I? Yeah, that's fair. Powell said there will be pain. He did. Maybe the pain is the inflation, not the recession. They like number 2, dual mandate, 2 years, 2%, etc. Tariffs will fix inflation. We'll be rich. Free childcare for everyone, he says facetiously. Back the dollar with homeless people. Ooh, that was dark. In reality, we are Victor Shrinks, not the other way around. But if I'm wrong, explain how. The Fed has been replaced with bootlickers. I mean, tell me when they weren't. You think Powell is starting to see the stag or the inflation? That was a gangster callback, zero expiration. What he's referring to was, I don't even know how many meetings ago, when it was, the writing was on the wall that in order to get to a better world, you've got to go through something. But they asked him what he thought about the potential of stagflation, and he said, I don't see the stag and I don't see the inflation. Gangster. It was sort of a gangster reply. But I think the problem is, if the chair of the Federal Reserve sees the stag or the inflation, it's too late. You got us there. So it's a clever line, but the problem is once the evidence is there, we've got a problem. Are we buying the E-minis here or wait for a sell-off at market open tomorrow? I think Tom said this Sunday night, and I kind of agree with him. I think you want to be a buyer of, this sounds crazy, I think you probably want to be a buyer of individual instruments. You find the instruments you think are at decent levels, and sell the and sell the majors against them. I'd probably go that route. Yeah, I'm gonna have to be very careful about what instruments I pick, because for whatever reason, my charts are taking forever. I'm not sure if that's my internet or what. What about gold, man? 2967. So I'm going to be very careful about the way I answer this. I've said this for a long time. I was hoping I would get gold under 2600. Didn't happen. So the way that I'm playing gold is through the miners. But the problem is the miners just took a bath last week, at the end of last week. And they got a little cheaper today. So if I was going to do anything, I would probably do I would be long miners again. I would use this as an opportunity to start maybe selling some out of the money puts in some of the miners that I like. Because vol is starting to go up a little bit in some of these underlying names, so they're inverse. So gold vol is to the upside, where miners you're going to get your more traditional skew. So I like the idea of maybe utilizing some of the volatility in the miners over the last 2 days that hasn't occurred in gold underlying. I would use it to sort of buy the miners or get some upside deltas in the miners. I also think if you actually looked into Newmont had a report. I mean, a lot of these miners had reports last week, and they were pretty good. They were really good. So I think a lot of that optimism was already priced into the stocks, and so you're seeing a bit of like, some of these people have held the stock for 2 months. It's gone from 36 to 48. And so on a report, you get the hot hands leave the market. They made a lot of money, and shouldn't be surprised. It shouldn't surprise a lot of people. And you find a level where people like me who are holding this thing for a little bit longer think it's interesting and you see the underlying start to stabilize. So that's my point of view and perspective. You don't have to agree with me. You can take the exact opposite position. I think gold, I'm still interested in the upside in. I would love, and this is one of those things, I've said this before, a good day in gold is plus 2%. A bad day in gold is down 5%. So now that we're at 3,000, a bad day in gold, it used to be $100 down day. But at 3,000, your 5% down move is a 150-point down day. And we had one not long ago. I would love to see a 150-point down day in order to get some very short-term upside deltas in gold. That would be my game plan. And until I get it, I'm just my upside gold exposure is going to be in the miners because I think I'm getting better pricing. And gold's been up how many days in a row? Effectively. So I don't know that I'd be looking. I don't know that I would get straight FOMO here at 3,000. I do think we break 3,000, and I think we go higher. How much higher, I don't know. But I think there's some part of me that believes that we are going to revalue gold higher, and this is the process of allowing gold to float higher. If you have that view of the world, which I do, and if you want somebody who has a really interesting opinion of gold and how it impacts the dollar and how it impacts people's sort of treasury holdings, I would say follow somebody called Luke Gromen, LukeGromen. He's got a little. He's got a firm, I think it's called Force for the Trees, FFFT, something like that. And he puts out content under that moniker as well. And I think he's one of the foremost thought leaders. I think he's really worth following, his opinion on this stuff. So my only thing is, do I think we're going higher? Yes. Do I think we're going straight there? No. And I would much rather, I like to start adding some long gold deltas after a down 150 day. So I thought Tom put out this idea of going short gold, I think long silver, because the gold to silver ratio is really, really high right now. I think at 90. Let me see if I can find a good gold silver ratio chart. I can put it in front of you guys just so you can see it. Again, for all the visual people out there, something like myself. Oh, that was horrible. But I think that if you had to do something, I don't want to be outright short gold, but if I had to do something right now, I'd probably go short gold, long silver, and just play that ratio comes in a little bit, which means silver would have a catch up either to the upside or the downside. And otherwise, I'm just sitting on my hands, waiting, hoping for a down 5% day to come anytime soon. See if I can get some upside deltas in at a cheaper price. That's what I would do. That's what I am doing. This one looks all right. It's not the best chart I've ever seen, and I can't vouch for its accuracy. It looks like it's in the ballpark, though. Let me show you. All right. So this is the gold-silver ratio since 1693. Again, can't vouch for its accuracy, but it is right now the gold-silver ratio is in the ballpark of 90. And you can see where this is historically. 90 is relatively high. What does that mean? It means historically the relationship is that that silver could advance in price, which would bring this ratio down. So if gold stayed the same and silver got more expensive, this ratio would go down and trade somewhere more towards its normal average, which is probably somewhere in the 60s to 70 range. So it's slightly elevated. So if that, I don't know if that answers your question. Somebody in the chat said, what about gold, man? I think that's probably the way I look at this. Hims went limp. You guys talking about Hims? I own Hims. It did get murdered. I think I'm going to stay long. But I do think this is one of the easiest companies. Like, they have no moat. Anyone can make this stuff. Who else is out there? There's Hims. There's Roe. There's Roman. There's so many of these things that I think it's hard to have a dominant market position. So you're sort of betting that they can emerge, but I don't know how they can be first of mind, but there's no like patent they can have on these types of pills, right? Pfizer had that patent, and now you're literally making your money off of selling generics directly to the public. And you can make your money off of scale and convenience. It has to be easy and faster and more efficient than the next person. And that's the race that we're in. We're in the race to cut margins and make that business more efficient. And then, they're doing the hair products on the side. I think they're moving into like women's products as well. So I think I still like that space. I just think it's going to be hard to win that space. Chinese ginseng. Yeah, or just exercise. Exercise, fruit. Vic, you're not supposed to take all the ED pills at once. I was just saying who the competitors are. Well, that's pretty funny. How can Hims compete with the cartel for these enhancement pills? Well, the patent has expired. That's why. So the Viagra patent has expired, so they can sell all of these generics on the market. That's what created the opening for all these businesses. And the Hims had, I think it was somewhere around here, November. I think this was when Amazon announced that they were going to do something with these types of pills and hair treatment, which I thought was hilarious because Jeff Bezos, I don't think he's the CEO anymore, but I'm like, this dude wants to sell you boner medication and hair loss treatment. And I used that old Jeff Bezos picture of him in front of that Amazon sign. I'm like, no thanks. I'm just kidding, being facetious here. But it's up 4% today. That's a decent recovery off of yesterday. I think a lot of these small cap stocks are still going to take a haircut, which is sort of ironic because they have done the worst. I think the closer we get towards 58, the more you bet on Russell over the NASDAQ. And the closer we get to 62, all I'm doing is recent. I shouldn't say that's what you should do. That's what we've seen. The closer you get to 58, the more you bet Russell over the NASDAQ or the SPOOs. Because as the market rallies, you get the broadening a bit. And then the flip side, the more expensive we get, the more damage they did to those small caps. So like today, on Friday, the ones that got hammered the most were small cap growth stocks. They were down something like 3.5%. Today, same thing. Small cap growth was down 0.9%. Small cap core was down 0.7%, and small cap value was down 0.5%. The next closest was mid cap growth was down 0.2%. Large cap growth did poorly as well. So clearly, the market is not interested in these small caps here. But I think the closer we get to 58, the more interesting the Russell NASDAQ or the Russell S&P spread becomes. We're probably too early, though. Vic, check HIMS again, down over. Yes, thank you very much. I did not see, thank you very much for calling it out. They had earnings after the close, and I did not check the aftermarket price, which is $42.25. So they're down about $9 from where they closed at $51.32. Thank you very much. HIMS had a short float of 30%. Can't be no reason for that. Yeah, I just think Johnson & Johnson, AstraZeneca, Novartis, and Amgen all have big drugs coming off patents this year. Don't worry, I'm sure we'll get some new diseases to address. Crude oil at 71. I still don't have a huge conviction on crude oil, but I still like energy stocks. You can't get me to stop buying those things. Copper still lower. This is about a week of lower copper. Freeport McMoran got murdered on Friday. A little bit of a recovery here today. I'm call me crazy. But I think they've done so much damage to this stuff that I'm starting to get interested in Freeport again. I'm starting to get really interested in Freeport again. But they've done a lot of damage to these materials. But I want to start to probably go shopping in some of the materials and keep shopping in energy. But let's take a look at some of the energy stocks. XLE is not one of my favorite. I forget. I got slow internet. We can't do this. XLE is not one of my favorite ETFs. A lot of these ETFs, quite frankly, are even SPY. I could say that about SPY now. Jesus. I don't love because, XLE is 45% two stocks, ExxonMobil or Chevron, CVX. SPY is like 40% or 35%, 7 stocks. I'm old enough to remember when an ETF was supposed to diversify your risk across a broad basket of stocks, not concentrate you amongst a handful. But that is the market we're in today. Pfizer owns the distribution channels for the generics. The only one I'd own. Fair. Can we get some Nvidia love before you go? I stay away from talking about a lot of these AI stocks for a couple of reasons. One, I think the market is so saturated with people talking about this stuff that I don't think I can provide a lot of value. That's number one. Number two is I'm not an expert in the space, and I think talking about AI, if you're not a subject matter expert, can leave you looking a bit silly. Like, I remember there was this point in time past sort of Apple's explosion of innovation and growth, where there was just a bunch of people on TV talking about how there's no cool new features in the phone, that Apple's innovation is slowed. It's like, yeah, that's a pretty hack opinion, my friend. You're sort of wasting TV time making that comment that every uncle in a lazy boy at home is saying. So I don't have a ton of, I think, real novel opinions on AI other than it doesn't work. At least the version that the people have, the version that the ants have, doesn't actually do anything. And the stock is not cheap on a backward-looking basis. And it hasn't been for a while. And for all of the hoopla about AI and about Nvidia, it's at the same price it was in June of last year. So I don't know. That's probably a lot of opportunity cost if you had money sitting in Nvidia since June of last year, given what a lot of the entire market did and a lot of what individual instruments have done. I get that before then, this was a meteoric rise, but the market is kind of a what have you done for me lately type of place. And Nvidia is at the same price it was in June. So you got a bunch of people that are talking about it as if it has a ton of, it's moving the same way it was moving 2 years ago, or for the last 2 years, and it's not. So I don't particularly think it's that interesting because it's not doing much. I suppose if you're selling vol on this thing, it's a bit more interesting, but it's not moving in price. The story is stale and known, and I can't provide a lot of deep subject matter expertise. But the one thing I can say is I can tell. Can you guys tell the people? I can tell when people are saying something that's coming from AI, and I can also tell when people are typing using something that came from AI. I don't think it's that hard. I don't think you need, people are like, well, how you catch people that turn in papers using AI? It's so easy to tell if somebody writes or speaks with something that they got from AI. It's so easy to tell. And I'm so want to do a swim move on those people. I'm not interested in some shit that some language model assembled from the internet. I don't care about that shit. The world is full of garbage. And the whole point of a human being is to take in all of this stuff, right? You go to a store because the store owner is a curator of material, and you like that store's method of curating a entire global economy of shit into a small subset of shit that you go to and you select from. If you like that store because of the curation of the store. I like a human being and their personality because of their ability to synthesize information and curate a world full of shit into some point of view. What the hell are we doing going around using the same engine to do your thinking, spitting it out to other human beings and passing it on as your own thought? What is that? Like, I don't want to be friends with ChatGPT. I want to be friends with Joe. What does Joe think? What research did Joe do? And how deeply did you go down the rabbit hole? When human beings want to study a subject, they do it deeply. and they become subject matter experts, and they understand the nuance of a topic. When ChatGPT does it, it doesn't know any of that. It doesn't know the nuance, or it just knows like some article said this thing and there's a opposing point of view over here. And it's like, it tries to be balanced, but there's so much nuance it's lost, and that a human being's deep subject matter expertise is worth listening to. And bro, I don't want to work with a bunch of chat GPTs, and I don't want to listen to a bunch of chat GPTs. Am I the only one? Victor is only AI generated when you see the gray shirt, Victor. Sounds like a George Carlin bit, Victor. Does it? Which I need to start watching George Carlin again. It's been a while. I've seen it a lot lately. And it's starting to bug me. It's starting to really bug me, man. I don't even care if you're wrong, you know? I don't even care if you're the guy who's kind of always slightly off, or you're sloppy with your research or your opinions, or the guy or gal. Like, the authenticity is refreshing. And just a world full of people passing off chat GPT clippings as original thoughts is infuriating. This is exactly what the most advanced AI would say. I mean, the one thing we have is our own humanity, our own ability to feel and to express and to articulate those feelings about the stimulus in the world around us. That is your humanity. And you're farming it away for what purpose? To sound smarter to people you don't know? For what purpose? Or some you do? To get a leg up on Ronnie in accounting? What are we doing? You know, it's like if I want to talk about a subject, it's sort of like this old saying that you got to know when you have enough information. Know when you have enough information. And there's a cognitive bias that is forming an opinion when you don't have enough information. And that, to me, is one of the most important. So when we chat GPT a really difficult subject and we get a synopsis back in 3 sentences, and then we regurgitate those 3 sentences to other people without ever doing the work, how much damage could we be doing if we didn't understand whether or not that thing was right or that thing was wrong, or what nuance needs to be delivered along with that 3-sentence regurgitation? But in the old days, you wanted to know something. Could you chat GPT it? No. But could you go read a book and study the subject? And then when you made a statement, you have some sort of foundation, some knowledge about the subject to have more than that 3-sentence conversation, to be able to field a follow-up question or two. I am not anti-chat GPT. All I'm saying is it's making a bunch of people, it's creating this new knowledge set or false knowledge set. You know, now there's right now it's headline knowledge. So you have the false impression that you know something or know about something because you saw a headline or a meme in your feed, and you saw it enough times that you think you're knowledgeable on the subject. But if somebody asks you a follow-up question, you fall apart in cross-examination instantly. And you're like, oh, okay, I know what this is. This is social feed knowledge you have. This is with the depth of a puddle. But then there's this new level of you can sound hyper intelligent about a subject with no research at all. And I don't know. It seems like it's feeding into cognitive bias versus breaking them down. In some instances, not all. All right, I'm sorry. You asked, so I answered. You got to be careful what you ask me, because I don't think these are types of answers you want. Already happened in the public school systems 30 years ago. Ronnie in accounting is the man. These AI models still make tons of mistakes. I'm not convinced AGI is as close as Sam Altman thinks. Here's my thing for bet. I'm under no illusion that I have the same version of AI that like Citadel has, you know? I'm under like these people spent billions of dollars to build underwater sea cables so that internet messages could travel faster than the next person. You know, they will spare no expense to have the best and fastest technology. So I'm under no impression that where it matters, those people are using the same version of AI that like Victor has with his $9 a month subscription or whatever. I don't think that's the case. I don't think Palantir is using like a ChatGPT model or something. So, yeah. So, I mean, we might be a lot closer than what I'm able to personally observe. That's my point. We might not be, but we might be. But all I'm saying is, but I would agree with you that the version that I have access to is an idiot. And I don't get the excitement. I can make it do some cool stuff. And I can automate lots of parts of my life. But that's, to me, that's technology is automation. It's always been automation. It's always been about automating away the lowest skill work. So I'm just saying there's nothing novel about what this thing is at this point, because what you're selling is intelligence and what you're buying is automation. To me, those two things are two different things. Victoria says, I sell aftermarket wheels and I can tell all the companies use ChatGPT have the same ad wording in the same business. Exactly, bro. We're purging government employees with all the knowledge. I don't know. Isn't that an oxymoron? Zing! Palantir using Hugging Face AI. All right, everybody. That's going to do it for me. I don't know if any of this. Let's do a couple more instruments before I get out of here. All right, so gold, it was gold-silver ratio. I'm sort of copying Tom on this one. I liked his short gold, long silver. I don't have it on. If I had to have something on, that's what it would be. I would love to just get lucky and call for a 150-point down day in gold this week, get it, and get long. But because I think that's probably a low probability call, Newmont Mining down to 44. I think selling some out of the money puts here, I am good with. So that's where I'm headed. FCX I think is cheap. Moderna is cheap. So either Moderna is going out of business, or we're going to get some new miraculous virus that needs to be addressed with mRNA, or somebody else will take the reins for mRNA technology because Moderna's name is too sullied in the COVID controversy. But I think what Larry Ellison is clearly trying to aim at with his partnership with Sam Altman and Masa-san, clearly it's a healthcare initiative first and foremost, and it's mRNA is a key part of that initiative. So I think having some chips on the table and some of those things is probably a decent bet. Not that I want it to happen. That's another emotional hedge. And we've had some pretty good luck with emotional hedges, unfortunately, in the past. We had an emotional hedge on private prisons on a Trump election, and it hit. We had an emotional hedge on the monkeypox vaccine. It hit. We had an emotional hedge on Palantir. It hit. These things don't always, I'm sure they're not always going to work, but I think an emotional hedge on an mRNA technology going into the next 4 years is probably a decent bet. God help us. All right, everybody. That's going to do it for me. I will see you back here tomorrow with a conversation. And I just realized it'll be the first in like 3 weeks with Ilya Spivak. So I'm looking forward to that. Lots to catch up on, lots to talk about with Ilya. I know I talked to him on the Sunday show, but I'm talking about a 90-minute one-on-one, mano-a-mano. I'm looking forward to talking with Ilya tomorrow, and then Chris Vecchio on Wacky Wednesday. So it's going to be a good week. I'm feeling good. Hopefully you are as well. Have a great week, everybody. We're at 6,000, mid-range, 50-50. So expect some waves. Nothing goes in a straight direction. But hope that we're going to get the opportunity to buy some distressed assets in the months ahead. Until tomorrow, I've been Victor Jones. Follow me on Twitter at Victor Jones. The O and Jones is 0 because I like to be difficult. See you back here tomorrow. Same time, same place, same great network. Only on Tasty Live. Peace.